picked up so much on Walmart's comments that the outlook for consumers had deteriorated materially over the previous 90 days, which is the reason why I'm interested in some of the retailers reporting earnings with disappointing outlooks going forward. How quickly are those outlooks changing as consumers start to pull back?
That's real GDP coming in. You look at Atlanta GDP now, I believe it's a sub 2% statistic. You're going to get that. And if you get disinflation, all of a sudden you get a nominal GDP well under 5% or maybe lower. And that's where this new worry comes up in a market that, you know, right now, futures negative 10. Come on, John. When do we go green? 10 a.m.?
We're negative 0.2%. The fate of this market for the rest of this week may be in the hands of some Fed speak and NVIDIA earnings. I'd throw in jobless claims as well. We talked about that repeatedly in the last couple of days. Claims, Tom, tomorrow morning.
Yeah, I'm going to punch that up here. You can do this on the Bloomberg Professional Service. The 4-week jobless claims, I got a statistic of 220,000. That's still a boom economy.
Well,
we've got ways to go.
When we've asked this, Tom, we're coming off exceptionally low levels. You're still focused on that? Or are you going to start to look at the change? And I think for many people, Tom, you've got to look at the change. It's picking up. It's moving in the other direction.
I look at a polarized America, and I'm going to look sector by sector. And as I mentioned in the last hour, I'd love to learn more about energy and banks. Let's do that. We can do that as large as Texas. Victoria Fernandez with his chief market strategist at Crossmark Global Investment. I have no idea how you reallocate, rebalance, Victoria, for next year. What's the Crossmark strategy?
Yeah, well, Tom, as you know, throughout the last year, when a lot of people were trying to make the decisions of whether to be in or out of the market, for our clients, we were completely in the market, but we were being very cautious as to where we were putting our money to work. We had a lot of defensive names in our portfolio while still having a little bit of cyclical names in there. And our strategy hasn't changed tremendously. On days when the equity market is up right now, because we don't think that we're in this solid bull market right now, we're trimming some names and we're going in to some of the names that have pulled back. You mentioned energy. That's one area where we've been adding some exposure to names like ConocoPhillips. We actually are adding into healthcare too. Healthcare has been decimated, but you look at the balance sheets of some of these companies and you have a lot of opportunity there. Adding a little bit of fixed income, having a little bit of cash, using some alternatives in your portfolio like covered calls. We think this is the time when you really need to have that diversification and be ready, because we think there's still quite a bit of volatility to go.
Do you get uncorrelated diversification in fixed income right now versus equities?
You know, not as much as you probably used to, but what you're going to be using your fixed income for right now is for the cash flow for our clients. So you can get a 5% yield on the short-term part of the yield curve. It's an opportunity to have something a little bit better than cash, a little bit better than government agencies. You can lock that in for a short period of time and then add a little bit, Jonathan, on the longer end of the curve where you can have that longer steady cash flow over a longer period of time to help buffer any equity volatility.
When you look forward, there's a real question about whether rate cuts next year are good or bad for risk. How do you think about that at a time when people are expecting the soft landing as the base case?
So I think there is a misconception here that the Fed is going to cut in the first half of next year. If you look, Lisa, over this hiking cycle, we've already had 6 dovish head fakes where the market has gotten ahead of itself, assumed the Fed was going to be more dovish than it was, and they've had to price that back out of the market. I think we're seeing a little bit of that now. I don't expect the Fed to cut rates until the second half of next year, and I think it will be more because we're seeing a deterioration in the economy than it is because of inflation expectations. I mean, look at delinquencies right now. We're back up at pre-COVID levels in regards to autos, in regards to credit cards, especially in that 18 to 29-year-old age group where they've got student loan debts coming as well. And as delinquencies go up at a time with very low unemployment, what does that mean for banks? It means they're going to increase their loan loss reserves. It means loan growth goes down. These are things that are going to stymie the economy. It's going to stymie the consumer. And I think that's where we're going to see rate cuts come in.
So when you take a look at your risk appetite heading into next year, do you think that people are overly optimistic about both rates coming lower and equities continuing to do well, led by the names that have done best this year?
I do think there's a little bit too much optimism right now, and I'd like to be optimistic. I like to say good things are going to happen, but look, we've said for the last year, you've got to be cautious. You look at leading economic indicators down again. Even coincident economic indicators are flat right now. Consumer is weakening. You've been talking about Mr. McMillan's statement about deflation going on and worries about the consumer. We've heard it in the retail earnings that have come out. And I think you're going to see some of the things that have been propping up the equity markets, like buybacks, start to come back.
But Victoria, you're living in Texas, the Austin boom. And the Austin boom, is a broad sense, is service sector and technology. How do you underweight the Magnificent Seven?
It's a tough decision to make on what you do with this Magnificent Seven. Obviously, the AI tailwind to those names has been tremendous. And we assume NVIDIA is going to report good earnings, and that's going to continue then to lead that narrative and help that Magnificent Seven. You have to have exposure to these names, you do. But I just think you have to be a little bit cautious and putting all your eggs in that basket. If you have, you've done well this year, so I can't deny that. But as we assume that we're going to have a pullback in this economy and the consumer is going to come back and capital expenditures and spending by corporations is going to slow down, I think you have to be a little bit concerned about what those earnings look like going forward. So have your exposure, but like we said, add that diversification in other areas as well.
Victoria, thank you. We've got to leave it there. Happy Thanksgiving. Enjoy the next couple of days.
Happy Thanksgiving, guys.
Thank you. Victoria Fernandez there of Crossmark Global Investments. I've shared this quote with you a few times already this morning, but for those just catching up, this from SocGen in their outlook on that narrow breadth, the dominant leadership of a handful of stocks, 7 names, the Magnificent Seven, as they've become known. The narrow breadth in equities will likely continue, Lisa, until a recession begins, the Fed rate cuts become more prominent, and the yield curve is firmly in positive territory. That's the call, the timing. Most of these triggers are said to be backloaded in 2024, so be constructive here. SocGen's basically saying the dominance of this narrow tech story is going to be where it's at.
Isn't this kind of the reversal of what we saw a year ago? Heading in, pain in the first half, and then gain in the second half.
Oh.
It was just gain and gain.
It was dip and rip, remember?
Exactly.
Yeah,
It was dip and rip, then it was rip and dip, and then now we're looking at, rip and then dip, I guess, back to that narrative. I mean, that's
What are we done with good news, bad news, bad news, good news?
I've got no idea,
bad
Tom.
news is bad
I'm
news.
losing focus.
Stuart Kaiser, Citi, he's sat around this table multiple times with
He's
us.
had a good
He's said it a
year.
million times. It's a rally built on a good economy. And he thinks when the economy turns, laser focused on claims and continuing claims, Tom. When the economy turns, he's basically saying you want to get out. You get out fast, be quick.
That's one of the opinions there. And then you still get this stunning 5,000 Bank of America.
I know.
5,400 yard Denny. How many more of these are we going to see? Is the new 4,700, 5,000?
I don't know who we're waiting for. I've sort of lost track of it all.
Is Mr. Wilson going to make an appearance? I've been waiting.
We need to catch up with Morgan Stanley. He's out with his call, though, yeah.
Oh, yes.
Minimal upside.
Yeah.
Minimal upside.
Okay. So he reaffirms a belief that it was smart. 8 months ago, he was the king of the hill.
You never
Tough
know.
business.
One bad earnings report from NVIDIA and a
Yeah.
hawkish Fed, and
It's like getting on
Watch
board
it
with the
unravel.
tots and then everybody gets injured. I mean, James
That was
Madison,
I know.
it's
I know.
crushing.
just to get everyone up to speed with the scores, not the football scores. Equity futures on the S&P negative
You're
here
on the Detroit Lions.
by 0.2%. Aren't they doing all right? Detroit.
The
this
Detroit
year.
Lions, Michael Barr will tell you, the great Michael Barr of Bloomberg
Detroit
Radio,
sports isn't terrible this year.
8-2, first time since 1962.
It's been that long.
It's been that long. That's how bad they've been.
Why have they been that bad?
I'll let Michael Barr answer that, but the answer is politics of the four. It's like the New York Giants. It's a family-owned kind of team, and it's just been a challenge.
I love
to say the
listening
least.
to him talk about it. He just starts basically like screaming
he's a
into
giant.
the microphone.
I mean,
he just is like, it's ridiculous.
I mean,
Like,
We're
this
talking
person
about
out.
Michael Barr
Yeah,
here.
Michael
Yeah.
Barr.
Okay, yeah.
This is not the vice chairman of the Fed. This is, although he looks like him, the Michael Barr of Bloomberg Radio. I mean, he walks down the street in Detroit. It's like he's Mitch Ryder of the Detroit
Oh, he's a
Wizards.
superstar.
He's like, it's like
It's the
Seeger.
voice.
It's a,
It's so
it's
buttery and
magical.
pure. It's just magical. I agree.
We do.
I
He
call
does
it voice of
Bloomberg
God.
Business of Sports. He's doing an entire show on AC Milan just to keep
Is he?
Pharaoh happy.
Am I allowed to attend
Yeah,
said show?
sure.
I'd love to come on and discuss.
Yeah.
I'd love to do
You
that.
could sit in the audience.
No, just sit and watch. Yeah, I'll just listen.
See what they have to say.
Damien
Valier.
Sassower, Scarlet Food.
Greg Valier of AGF Investments.
Oh, good.
Coming up next, we'll talk to him about the latest in the Middle East, the prospect of a truce.
He
Some
goes
kind
out.
of truce.
He goes out and shoots the damn turkey.
That's a very different story.
New Hampshire,
Okay, well,
New Hampshire woods.
maybe we'll have that conversation too. I mean, I've got no idea what you're going to do. From New York, this is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I don't think there's any doubt in my mind that if the opportunity arose for Israel to send their special operators in to get these hostages, that they would wait for negotiations. No, in fact, I think they're very much against any kind of ceasefire or humanitarian pause in the first instance. This is something that's being pushed by Qatar, by Hamas, and candidly, the United States.
That was retired Brigadier General Mark Kimmett speaking on Balance of Power. The latest on this conversation, the reporting led by Axios this morning, as they would say the state of play. Two sources with direct knowledge of the talk telling Axios that as part of the hostage deal, Israel would release 3 Palestinian prisoners, Tom, held in Israel, for each Israeli hostage released by Hamas. There's 2 phases to this, but that would ultimately be a summary of events, Tom, that could take place as soon as today.
And with the huge narratives, as soon as today is the key point here. We're really hanging on this by the minute. I mean, the bottom line is, I think the entire people following this, the entire press corps is waiting really by the minute.
It's the latest reporting. Anne-Marie cautioned that we've talked about this many times, but if you do get this today, Tom, by far the biggest diplomatic breakthrough of the last month.
It will be, and it's, to hear Mark Kimmett talk about it, the former general with some real world experience here. And if you imagine the military operation in Gaza going further, Kimmett has been just visceral about the violence of going building to building.
To Kimmett's point, Israel has been against any kind of ceasefire. The reports today are about some form of multi-day ceasefire, Tom. So it will be very interesting to see if this comes together.
We'll have to see how that goes. Right now, on politics and on the moment of this election, on top of us, January 23rd, I believe, in New Hampshire, is his New Hampshire. Greg Villiers joins us, Chief U.S. Policy Strategist at AGF. Greg, 8.3 million new voters will be eligible in 2024. They age into their ability to vote. What's the history of 18 to 22-year-olds showing up?
Well, it's often been disappointing, Tom, but at the same time, this is a big number. And there's an issue that has really motivated young people, and that is the war, the Hamas-Israeli war. Polls show that overwhelmingly young people are opposed to the Biden policy. Biden's poll numbers are dropping fast, as you know. So the young people coming into the system will put pressure, I think, on both parties to reach some kind of settlement.
Do those young people want to vote for the former president?
Donald Trump? No, not necessarily. I think of most young people right now would say none of the above. But I think that on many fronts, you have to say that Joe Biden is not connecting with young people, whether it's Taylor Swift, the gaffe that Biden made yesterday, or whether it's far more serious issues like this war, like what's going on campuses. I can't defend a lot of what's happening on campuses, but I live in a city that's addicted to the polls, and the polls show real movement among young people.
We've been talking about this for a while, Greg, and it only has become more so as the polls continue, and you can name the reason why, but it's been a consistent trend of a deterioration in Joe Biden's popularity. How serious are the discussions getting around getting a different nominee to take his place?
I think this reached a turning point, Lisa, over the weekend, in which Biden profanely criticized his critics, and I think that he has made it clear that he is not dropping out. I would be very, very surprised. In many states, the filing deadlines have come and gone, so I think he's in. I think it's Trump versus Biden, and that's not a real palatable choice for an awful lot of voters.
Joe Manchin has been making the rounds, and he's flirting with potentially running for president as an independent, talking about how neither president really is gaining traction with potential voters, former president and the current president. From your vantage point, do you think that there is a viable independent candidate who could actually win versus just take votes from one or the other of the potential candidates?
Yeah, going back to my home state of New Hampshire, there's a poll that showed Robert F. Kennedy Jr. at 22%. That, to me, was astonishing. You know, one other thing that I don't understand, frankly, the New York Times had a big front page story this morning about the disconnect between how the economy is doing, you know, low unemployment, inflation falling, and how people view it. People's view of the economy does not fit with the data at all.
Okay, it doesn't. Why is that? I mean, to my great theme, Greg, for this year, and I'm stealing this from Lyle Brainerd, it's a cumulative in inflation. I mean, CNN just had it on, folks, at Justin Wolfer's thing we saw on Twitter. The price of Thanksgiving dinner is down 4.5%, but it's up 25% from 2019. To me, Greg, that explains the electorate.
Yeah, exactly. This disconnect, if it persists, will be still another huge albatross for Joe Biden in his re-election effort. You know, maybe next year, if inflation is clearly falling, things will change. But I think right now, an awful lot of Americans still are nervous about inflation coming back.
This inflation, Lisa, I can't say enough how, you know, we're weaned on month over month, 3 months annualized, year over year. Throw it out the window. I see anecdotally every day from every person, it's a reset from December of 2019, maybe February of 2020.
So let's connect this to where we started the conversation, which is the war between Hamas and Israel. Greg, by next year, is it going to all be about the economy, or is still there going to be this hangover that we see currently that's really eroding some of President Biden's popularity?
I think by the end of the year, the war will be over. There might be scattered resistance, but I think that outcome is inevitable. Sadly, that's not the case in Ukraine. But I would say with the war is still another source of anxiety that Americans have, and I think they feel that Washington is not listening to those concerns.
Do you have a sense of what people want to happen, of what would be considered a positive, both just humanitarian but also political outcome for what's for this war?
I think people would like clarity. If this war does not end conclusively and it drags on, I think that would be extremely unfortunate. And I would say this, I think Netanyahu and the Israeli intelligence community has to answer for the fact that they got totally blindsided. This cannot happen again.
So many questions still about that more than a month later. Greg, thank you. Greg Valliere there of AGF Investments. Just slightly distracted by some of the headlines crossing right now. Netanyahu, we are making progress on the return of hostages. I hope there will be good news soon on hostages. Those comments, and we'll keep an eye on those headlines as they cross, following this reporting from Axios. A deal between Israel and Hamas to free dozens of hostages and declare a multi-day ceasefire is imminent, Lisa, and could be announced by the Qatari mediators as soon as today, according to 2 sources with direct knowledge of the issue.
What I find interesting is where the pressure is coming from. We were talking with Anne-Marie earlier, and she was noting that Israel has said that it doesn't want a ceasefire of any type until Hamas is eradicated. At the same time, internally in Israel, there is so much pressure to get the hostages home, and there's also growing pressure against Netanyahu's leadership because of so many people and how unpopular he is, and some of the mistakes and frankly hardline approaches.
I thought Anne-Marie Horton was great there. We have to be clear, it's not quote unquote all the hostages. We're only talking about a small group of them. That's better than none. But this is not like other hostage discussions where it's all the hostages.
The number that Axios went with in phase 1 was 50.
50.
Tom.
Out of 200.
And then maybe
whatever,
another 50 in a second phase, but certainly not all.
Yeah, that's the key thing here. And the other thing is the military effort as they move from north to south in Gaza. I mean, horrific's the only word I can come up with. The images and the maps and, the rest of it.
You have to agree. It's just been tragic all round over the last 6 weeks or so.
There's no other way to put it.
Conversation continues in the next hour on Bloomberg TV. We'll turn to the markets. Emily Rowland of JH Investments, Brian Levitt of Invesco. Brian Levitt, I remember this line from Brian early this year. I'm a FOMO guy. I'm a FOMO guy. And in the moment he said it, I just started laughing. But guess what? His fear of missing out made sure that he did not miss out.
But he's on
because
of Michigan, Ohio State, right?
Is that right?
I mean, that's to get a brief.
I mean, I can ask him about it if you'd like. And then Gersten Distenfeld as well. We'll talk about credit. That maturity wall out there, Tom, in 2025, and whether these companies are going to use this move lower in yields and these tighter spreads to opportunistically, Tom, issue some debt and get ahead of it.
And trust me, I'm an amateur on this. I can't wait for Gershon to speak. They have a wonderful joy in issuing debt here. It's a no-brainer to take debt of 8% or 4%, these stupid percentage numbers, and get it out to something that's in the textbooks.
There's a window there. It's about whether they take advantage of it and how long that window lasts. Thank you, buddy.
That's good.
I appreciate it.
That's good.
Team effort.
You working on the sides to start today?
Yeah, mac and cheese. Nice.
Really?
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model. Do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance, good morning. Jonathan Farrow, Lisa Bramlett, and Tom Keene. Mr. Farrow on assignment. He's working on his side dishes. He's starting them in here before the 9 o'clock.
He has mac and cheese.
He's got mac and cheese, and we're debating potage here. And you got to go with the mashed potatoes, and it takes days of preparation.
Sweet potatoes with marshmallows on top.
It's
Just
un-American.
That's not un-American. It's classic American.
We'll be with you tomorrow, Wednesday.
Cookie
I don't
channel.
think we're here Thursday,
No.
and then Friday's a toss-up.
I'm here alone. You guys are going to ditch me in the sides.
We're going to see. It's going to be an interesting week with a huge economic data dump here. Tomorrow, we squeeze 3 days into a holiday Wednesday here, and we're going to talk a really important conversation with Citigroup here in a moment. But right now, our Michael McKee, our international economics and policy correspondent in charge of Thursday football, as well. Mike, I guess Thursday football, Thanksgiving football, is more interesting than the economics today. We wait for the data dump tomorrow. What do we need to look for tomorrow besides claims?
Really, claims are what you're going to be looking for. Durable goods orders will be interesting to see if businesses are still spending. Those get revised once we get the factory orders numbers, so they won't be definitive. Claims, obviously, people want to see if the 231,000 we got last week was holiday caused or some sort of oddball number, or whether we're really starting to see a larger and larger group of people getting laid off. So a lot of interest in that tomorrow morning before people hit the road to go home and watch football for Thursday. Today we get the Fed minutes, and it'll be interesting to see how many people really care if the Fed minutes give us anything besides what we already know.
Frame that out for us. Help me, 3 weeks old? How old are the minutes?
3 weeks old. They're
Is
3
that
weeks
ancient
old,
in your
and
world? Is that ancient?
It's definitely ancient, especially now, because since the meeting, we've had the jobs report, the CPI report. We've seen a major reversal in the jump in interest rates along the yield curve, which may have been a reason that the Fed cites for why they might want to have held rates where they were at the last meeting. So a lot has changed since then. There's a lot more new data. I think what people will be looking for is any kind of criteria in there, criteria for whether they raise or lower rates, or criteria of where we can try to figure out what they mean by longer in higher for longer.
I've been really interested in the economic data that I've gotten from retailers this morning, the sense that they've been talking about the consumer and waning demand. We're looking at Best Buy, seeing what they call uneven consumer demand this morning. This was part of the reason why they cut their forecast. We heard similar types of messages from Macy's, Target, Gap, also, of course, from Walmart. Mike, how much is there this divergence going on with ongoing weakness in goods sectors, even with resilience in the services?
Well, it's been going on for a while, and it's likely to continue. The question is, do people really intend to slow their spending, or are they going to time it differently? There's some thought that what maybe people are waiting for is prices to drop. Retailers have suggested, and Walmart was the one that got a lot of headlines for this, that we might see prices go down during the holiday season, and that would mean that people might hold off on buying. Last year we saw a jump in October sales. This year we didn't see that. So maybe people are waiting, or maybe indeed a slowdown's underway and people aren't going to spend as much money.
Michael McKee, thank you so much in Washington. This is a joy, and we look back, and we rarely do this. You look back at the people that tanked, you look back at the people that were successful, but we can say without question that Citigroup has had one hell of a year in forecasting the American economy. Andrew Hollenhorst and others, a broad team, have just hit the ball out of the park on higher rates, and some of the nuance change here right now. Driving the ship at Citi, their global economist is Robert Sutton, and he joins us right now. I want to go to the heart and soul of your economics, and I would say the heritage of Catherine Mann and Willem Wouter as well, which is you studied under Salah E. Martin, Xavier Salah E. Martin at Columbia, and he is, in my opinion, without question, the growth optimist of generation of economics. Do you share Salah E. Martin's just sheer optimism on global growth?
I do. I think long-run economic growth can be really benefited by growth in productivity, innovation. There's a lot of scope to do a lot of good, and that he always taught me that it's not a zero-sum game, that the pie can be divided more equally globally. I think for the next year, something we've been highlighting is more pessimism, that we think global growth is going to be quite soft as we head into next year. That's more the cyclical factors that we face. So we do think we're in for harder times ahead, but broader term, long term, absolutely an optimist, similar to...
So you would push against the IMF's 2028 call of a subdued global growth, and that somehow, as Salah Martin and others would say, somehow we do generate growth from other factors that surprise along the way.
Yeah, we think right now we've seen a lot of resilience in the global economy. So if you went to the end of last year, we thought global growth this year would be running somewhere below 2%, about 1.8. We're tracking about 2.5% in market exchange rate. So a pretty big upside surprise. Most of that has been due to the U.S., but we've essentially shifted that weakness out into further quarters because we think that post-COVID services momentum is starting to fade, that those interest rate hikes are going to start to bite more as we get into next year, and that manufacturing weakness that we see globally is going to start to undercut activity more broadly. So we are holding on to that slowdown, but we've been surprised to the upside throughout this year.
So let's talk about not the longer term and the optimism, but the shorter term and what you just said, which is you do think that we're in for harder times ahead. What does that look like at a time when people are expecting this gentle slope upward in the unemployment rate and just sort of a general decline in consumption until we get the rebound? Do you push back against that view?
Yeah, we think that eventually these interest rate hikes are going to have to bite more. You're starting to see some evidence, even in the U.S., where the data have significantly surprised us to the upside all year. That's been the source of most of the upside markups in our global growth forecast has come from the U.S. But you are starting to see some cracks. So you are seeing credit conditions that have tightened significantly. We've done some work that say that tends to play through the economy over a 2-year period. So some of that may still be in the pipeline. And you're starting to see some strains on the lower income consumer side, where you're seeing rising subprime delinquencies, rising credit card debt. They've drained most of their COVID excess savings. So we think more of those things are going to start to bite going forward. But that being said, certainly the probability of a soft landing has gone up materially. We've seen a lot of these factors stay just yellow warning signs, not red warning signs.
Which is the reason why I guess people are trying to understand whether this is like all the other times where it becomes nonlinear and you start to see unemployment pick up in a more material way, or if this time truly is different, given some of the discussion from retailers and the forward look at how quickly things are moving, whether it was Walmart, whether it was Best Buy today. Does that make you feel like something is happening more quickly in terms of deterioration?
Yeah, absolutely. And to that nonlinear point, if you look at the history of cycles, the labor market tends to turn towards the end of a cycle, tends to move very rapidly after a period of relative stability. And if you look at the lower income consumer segment that I mentioned, when they pull back in spending, it tends to be very sharp and very quick. So I do think you could get this nonlinearity, which is why it's very hard for economists to call recessions. So that does worry me, but at the same time, the resilience we're seeing has been, very encouraging. We're seeing stronger growth and inflation coming down more quickly.
This is critical because everybody looked at the Hollenhorst call and said, this kid from UCLA is nuts. It's not going to happen. And if it does happen, we're all going to tank and the world's going to die. And the core issue here is we got the Dudley, L. Arian, Andrew Hollenhorst Citigroup call, and we didn't die. I mean, that's Econ 101. Sometimes you get lift in rates and it actually benefits the system.
Yeah, and to Andrew's credit, been very far ahead of in this cycle, calling things early and calling things very right. And I think to your point, we really haven't seen the effect, especially in the U.S., of these higher rates yet. If you look at mortgage rates, for example, well above 7%, the effective mortgage rates in the economy has been closer to 3.5% because so many people are on fixed rate mortgages. Corporates termed out debt throughout this cycle as well, and you had that excess savings story where consumers, particularly in the U.S., built up a lot more savings throughout the cycle, and we still think there's a fair amount of that left. So rates have gone up a lot, and as you said, growth accelerated in the third quarter.
Let's get you in trouble here. I mean, Clarida was Dean of Economics at your Columbia. He's saying there is a new R-starred. Are we going to go back to John Williams' 2%, or can we settle out anchored at a higher R-starred, a new imputed inflation into the system, if you will?
Yeah, and that's certainly a big debate. Our view has been that the post-COVID world is going to look mostly like the pre-COVID world, and so R-star hasn't moved very much. But maybe what you're seeing is exactly that the economy has held up so well because it can, sustain a higher level of interest rates. And so that's certainly a key part of the debate.
What data is most interesting for you in the next 2 months or next month and a half that we have in the remainder of 2023?
I would say two factors. One is wage growth. Can we still see wage growth continue to cool from very elevated levels? We think that the Fed's comfort zone for wage growth is 3 to 3.5%. It's still running 4 to 4.5% depending on the measure. That's down from near 5.5% at the cycle high. So we've come a long way down, but there's still a long ways to go. So I want to see if that wage growth can continue to cool. And then consumption. We've seen enormous upside surprises from the consumer throughout the cycle. Can that continue?
Robert, thank you so much. Robert Sockin with us with Citigroup, their global economist. There's some form of breaking news here, Lisa. I want to read it verbatim to be sure I get this right. This is Politico within the maze of rumor and speculation, and the operative word is has. The United States has brokered a deal between Israel and Hamas to free dozens of hostages held in Gaza in exchange for a 4 or 5 day pause in fighting, according to 2 current U.S. officials and a former U.S. official with knowledge of the talks. They hedge that nicely. It's a speculation of war, but certainly in the wonderful timing of having Robert Hormats with us here in a moment, that is good news.
And in tandem with some of those headlines, we're seeing other headlines from other sources that the Israeli cabinet is going to meet in the next few hours to review the progress on hostages. So it does feel like it is live and actually happening in a more material way than has been over the past couple of days.
Widely rumored through the day, but then you wonder where this goes into the weekend and the length here. They do mention a 4 or 5 day pause, which I'm not sure what you do with that besides humanitarian aid.
Well, humanitarian aid and getting some of the hostages out. Just to be honest, all of us are looking for resolution, for an end to the death, for an end to the hostages, for an end to some of the destruction in Gaza, with some resolution potentially in the works.
See on that, we're thrilled that Ambassador Hormats will join us here in about 3 minutes. You'll want to stay for that. The Standard & Poor's 500 down 13 points, down 0.3%.
I've got to say, when we have this conversation with Robert Hormats of Tiedemann Advisors, there's a real question here, both internationally but also domestically, and we've been talking about it throughout the morning, but how the U.S. is sort of influencing some of these talks at a real fraught time, and one where there's a lot of disagreement, frankly, within even the Democratic Party about how to proceed.
And with the death of Rosalind Carter and the fragility of the former president, the images of Jimmy Carter with Anwar Sadat and others, I mean, to hearken back to 67 and then all that was done many, many years ago, you wonder how those images will look forward if we somehow extricate ourselves from this.
We're going to get to talk more about politics in the next, 12 months. Well, it's going to heat up. We're going to have, it's going to become more and more of a focus. Will markets care? I mean, this is sort of one of the questions. Is it going to be all about the deficit? No, I think they've proven they don't. Well, except unless there's a bond auction and then all of a sudden they care a whole host more. And there is this question next year how that's going to heat up, especially without any resolutions coming on the debt story.
West Texas Intermediate, $77 a barrel. Brent crude, $82 a barrel. Pretty much unched there. I'm not going to say much about that. I do want to point out the 10-year real yield with a shock early this morning, 2.11 is lifted 2.15%. I brought this up yesterday. Nobody's listening. Do we revisit 5% 2-year yield? Nobody's looking for that.
Yeah, and at the same time, it's creeping a little bit higher. You're right. You're right to raise that.
Yeah, well, we'll have to see. Dollar weaker as well. Pharaoh's looking at the euro. 109.45. He's going for the big bird with Thanksgiving. He's living large with sterling 125.
Just the breast. Didn't he say just the breast? He just does the breast.
It's just, you know.
I like dark meat.
Coming up,
I do.
Robert Hormats on Israel and Hamas.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We do want to get the latest on some of the breaking news. We are hearing that there has been some sort of resolution, some sort of agreed upon truce, or at least a ceasefire on the part of the Israeli-Hamas war and some return of hostages. Let's just get the latest. Anne-Marie Hardern joining us here, who's been covering all this for us. Anne-Marie, what do we know?
What we know right now is that they are very close to a deal, and I have this, so do some of our colleagues from a number of sources, whether or not it's the United States or also in the Gulf. This would be for potentially as many as 50 to 100 hostages that were taken by Hamas. We know that's around a number of 240. So this would be 50 to 100, only women and children. It would come with a number of days of a pause, potentially 4 days of pausing of what is going on in Gaza with these Israeli bombardments. On top of that, it would also mean Palestinian women and children would also be released from Israeli jails. And we can see this as soon as today. My sources are saying it is very close. And I would read some of the tea leaves from officials. We heard from Ismail Hanai. He is the political leader of Hamas that's based in Doha. And he came out on Telegram saying they're very close to a truce. And then the president yesterday said they were close. He didn't want to lean too much into it because obviously when you're dealing with hostages, these deals can break down. For many weeks, I was very close to being able to reporting something, and at the last minute, the deal broke down. But the president yesterday went like this, put his fingers up, crossed, and Admiral Kirby said it's the closest we've ever been.
One question quickly before we get to Ambassador Hormats. What happens after 4 or 5 days?
It's a great question. We don't know yet. I think many people...
It's a prosecution of a military strategy, right?
Well, many people want to see the bombardments to slow down. there's a lot of pressure on Israel. Israel didn't want to do any sort of ceasefire or pause, even though they're different. Didn't want to do anything until the hostages were released. But they realized that these hostages were not coming out unless there was a pause.
To be followed through the day, please stay with Bloomberg all day. And sometimes you get lucky, and we do that always with Robert Hormats. He is of Tufts, and he's of generations of presidents. This could easily be a 3-hour conversation, Ambassador Hormats, with the Yale School of Management. So many narratives. Bob, you and I could go for 3 hours right now. We got about 7 minutes. There's James Earl Carter with Sadat from another time and place. We have a nostalgia for that moment that you lived and the success of with Brzezinski and the rest that you lived. What imagery are we going to see when we extricate ourselves from this war in Gaza?
Well, I think at that point there were two interlocutors that Carter was trying to pull together and was able to do that. Now you have a much different environment. You have Hamas, you have the Israelis are divided. Hamas is a very inchoate kind of operation. You know, it's not quite clear how much power the center of Hamas has. It's a very dispersed organization. And we really, with hostages, as you've correctly pointed out, you really don't know until it's actually done. Remember the movie The Bridge of Spies? They didn't actually know that the transfer was going to take place until it did. They arrived. And I think these things are very sensitive. But what's very important about this is that the United States and Qatar have played this intermediary role, which I think is constructive in that it gets the United States back into the game in a positive way.
Robert Gates, my essay certainly of November in Foreign Affairs magazine, it's a primal wake-up call on American diplomacy is being efficacious. You have said this for decades, Bob Hormats, that we can't let down our diplomacy. What does our next diplomacy look like after what we've lived the last 8 or even 12 years?
Well, that's the interesting point, that is, during the Cold War, diplomacy was Washington, Moscow, essentially. And now you've got lots of power centers. Obviously, this summit with the Chinese was, I thought, a very constructive summit. And actually, I'm going to China in a week to talk about what kind of progress can be made to support what was done in the California summit, but opening up new opportunities, I think, for business and for diplomacy. But talking to a number of people about how we move the very constructive process that was begun there along. But you also have a variety of new power centers that you have to have very proactive diplomacy. India is playing a greater role, particularly in the global south. Iran's a power in the region. Saudi Arabia is playing a much greater role. So you have to have a much more agile and a much more diffused diplomacy. There are lots of power centers of different levels of power, but a lot more influential countries than there were in the past.
Which is the reason why there was a lot of focus on China's meeting recently with Arab leaders and wondering how exactly they were navigating something that they really haven't taken a particular stance on. What did you glean from that?
Well, that's a very good example of this. The Chinese really, for years, played virtually no role in the Middle East. They have a base in Djibouti, but that's sort of north and out of the framework. It's really on the tip of Africa. But they were not engaged in the Middle East. Then, sort of a surprise, we find that they brokered a deal between Saudi Arabia and Iran. So it's clear that they have a new positive, proactive, and I would say in that case, quite constructive diplomatic approach. They have very sophisticated diplomats. We shouldn't underestimate the quality of the Chinese diplomatic corps. They're very good. So they're playing a greater role, and the fact that we're now re-engaging or engaging in this diplomacy to help deal with the hostages with Qatar sort of shows that we're now coming back into the game and playing a constructive role. But we're going to have to do this in a whole lot of countries because there's a lot of power centers, and we're going to have to play a role if we want to play a global role in a variety of regions.
The more I read, the less I feel like I know about what's going on in the Middle East right now in terms of where the power centers are, who's brokering what, how, whether Saudi Arabia is getting more sort of aggressive with Israel or not. Do you have a sense of just whether there still is this animosity between Iran and Saudi Arabia, of whether there is this move from Qatar and Egypt and others to move away from Israel? Do you have any sense of exactly how this tide is shifting?
It's very hard to read the tea leaves. I would say that Iran and Saudi Arabia probably still have a lot of questions about each other and a lot of suspicion, but at least they're engaging in conversation in a way that they weren't before. And I would say it's probably true as well. I do think that the Sunni Arab countries in the region did want to have and still do want to have a close relationship with Israel. This, and one of the reasons I think Hamas did this horrible thing is that it didn't like that was going on and thought this would interrupt that process. So I still think the underlying goal is to have a greater degree of normalcy between Israel and the Sunni Arabs.
You just celebrated your 80th birthday, and I think I can say between you and Michael Bloomberg, you are as well preserved as anybody I know. What's the damn secret to looking this good at 80?
Getting up early and coming on this show.
Okay, that's the right answer.
That's right.
I want you to talk right now about this crazy American gerontocracy that we're living right now. The president's 81, the other guy's 78. How did we get, half of Congress is 92. How did we get here, Bob Hormats?
Well, you've asked a question with really two powerful ingredients. One is we certainly need to begin to tap the younger political leaders, and there are plenty of very good people who are in the process of moving up in the political process, but the older leaders have sort of taken the oxygen away from them. They don't get to participate in a lot of the proactive debates that are going on, because you've got two leaders who are older who take a lot of that oxygen, the political oxygen and money, away. But the second point that's even bigger is we have to start thinking a lot more of the implications of what we do today for the next generation and the next generation and the next generation. That particularly has to do with the budget, because we're leaving our children and grandchildren with.
Well, this is your book from a couple of years ago. Right. When's the second edition out?
And
you got to redo it.
I just did an article for Fortune magazine explaining why this was a problem and what it was going to mean for Social Security, what it's going to mean for the budget, for contingent liabilities, and the numbers are up and up and up. Who's going to pay the interest? Our children and grandchildren. We're leaving them with a burden. That's one. Climate's another.
Breaking news is getting in the way. Bob Hormats, I got to cut you off. Thank you so much for joining us. Anne-Marie, to you, 20 seconds. Any breaking news here into the 9 o'clock hour?
Just that we remain very close to getting this hostage deal done. We also did hear from the Israeli Prime Minister, though, Benjamin Netanyahu, and the Israelis are tweeting that they will have a war cabinet meeting this evening.
Stay for this, and Anne-Marie Horton, Balance of Power. Look for that this evening. We say thank you to Robert Hormats of the Yale School of Management. Please stay with us with futures at -13. NVIDIA this afternoon.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived. Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that
needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Five-day winning streak on the S&P 500. Live from New York City this morning. Good morning, good morning. Your equity market's slightly negative on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the Nasdaq sitting at 22-month highs as high-flying NVIDIA reports after the bell and OpenAI confronts a potential staff mutiny. We begin with the big issue, the magnificent one.
We're looking to NVIDIA results.
The NVIDIA number. NVIDIA earnings. This is going to be a big number in a quiet week. The big number that's going to drive tech this week. The expectations are starting to rise. The market really expects a phenomenal beat. Another stellar quarter.
Probably pushing to a new high on the back of brand new demand from sold out AI chips.
Whether or not that is already reflected in the price is the key question.
This is still a market that is very much driven by the Magnificent Seven and very much driven by mega cap tech. It was the last to come down. It came back the strongest.
It's been very, very narrow, the leadership. It's been led by NVIDIA.
With NVIDIA up over 200% year to date.
NVIDIA alone has contributed to a big chunk of those year-on-year growth profits.
This AI boom.
This has a lot of legs. It is in the early stages of what we think is a long-term secular bull market. NVIDIA is certainly the one to watch.
Everyone's going to be watching.
Everybody's going to be watching. It is the main event after the close a little bit later to discuss Invesco's Brian Levitt, John Hancock's Emily Rowland. Emily, let's begin with you. Can this narrow leadership in this equity market continue?
Yeah, we think it can, John, and it's pretty typical of a late cycle environment where you see this, remarkable multiple expansion. It's kind of crazy to think that bond yields have gone up over the course of this year, yet we've gone from about 16 times forward earnings to about 18 times forward earnings on the S&P 500. Pretty unusual to see, and a lot of that's been driven, of course, by tech, and frankly, the earnings have been there. It's just this multiple expansion that's been really, really extraordinary. We like quality. NVIDIA is quality, and we think it makes sense for investors to pay up for quality, but we're also looking at ways to diversify away from valuation risk in the space.
Your view is shared by those over at SocGen that this narrow leadership continues until we get a recession. The narrow breadth in equities will likely continue until a recession begins. SocGen go on to say the Fed rate cuts become more prominent and the yield curve is firmly in positive territory, but most of these triggers are set to be backloaded in 24. Brian, how do you think about this particular issue?
Yeah, I disagree a bit. It's
what we're seeing right now is a market that is very enthused about a soft landing. Now, that doesn't mean that we necessarily get a soft landing, but what we have is inflation, which has come down, an economy that's looking pretty good globally, and risk sentiment that's picking up. So what we're seeing is an environment, another period like we saw from the middle of October 2022 through February, March 2023, where you saw better participation from value stocks. You saw equal weight outperforming the market cap. You saw international participation. Quite frankly, we've seen that since the weak consumer price index on November 14th has been other parts of the market participating. And I think that's going to continue through the end of the year into the beginning of next year.
But Brian, decelerating growth, is that not a challenge to that call?
It is, except if you look at the world globally right now, what we've had is a period where the economy has been below trend and may actually be picking up a little bit globally. So that does create more of a risk-on backdrop. Now, at some point, you'll slow. At some point, this economy will go through the slowdown, the lagged effects of policy tightening, which are taking time to show up. And in that slowdown, you'd want to shift to quality, back to mega. But what we see here is a window of opportunity to take advantage of a so-called soft landing trade. Again, similar to what we saw coming out of the middle of October 2022.
How big's that window?
I would expect it to take place through this year into the first quarter of next year, and we'll be assessing. I mean, we look at this with high-frequency data, and our high-frequency data right now has risk sentiment moving higher, and as risk sentiment moves higher, it tends to lead some recovery in the economy and some improvements. So for now, we're risk on, and we'll be assessing it monthly.
Emily, you appear to have a different view to Brian, don't you?
No, I actually agree that there could be a window here, John, and this all comes down to the weaker dollar. All the markets care about right now is disinflation. And here goes the playbook. Disinflation means lower bond yields, means the dollar falls, which causes this global risk-on rally. You know, it's almost like this global liquidity release valve where financial conditions become looser. You find this better for U.S. corporate earnings. 40% of our revenues are derived from abroad. And you've seen, you know, it was unbelievable. Brian mentioned the CPI report. You know, it came in slightly lighter than expectations by about 10 basis points. And you saw this massive rally in areas like international equities and small cap stocks, as you saw that significant period of dollar weakening, you know, and the technicals are there. We actually look at the fundamental picture for the dollar being one where we would expect to see it strengthen based on economic growth differentials, a tighter Fed here in the U.S. But right now there's a simple thing happening, which is that traders are following this weaker dollar picture. And if that can persist, that would be the window that we would be looking for to see this risk-on rally continue, at least over the short to medium term.
I'm with you. 10 basis point downside surprise, and all of a sudden, boom. It was absolutely ridiculous just last week. I can't believe that was only a week ago, by the way. Equities right now negative 1/3% on the S&P. One name in focus after the close, NVIDIA, a record high ahead of these results. Ed Ludlow joins us now for more. Morning, Ed.
Yeah, good morning, John. NVIDIA is a little softer in the session, but I don't think there's any surprise on that. There is a high hurdle going into these earnings, but what's interesting is that the average of analyst estimates for 171% top-line growth, there are corners of the market that see that as conservative. There are corners of the market that think NVIDIA will beat that 171 top-line growth by a margin of 5 to 10%. And it's interesting and important to note what's happening here. The H100, its kind of mainstay GPU or AI accelerator, is supply constrained, right? So even though there's concern about China, where that has historically been 20 to 25% of data center revenues, if the demand there is not meetable, there's plenty of demand elsewhere. When the earnings drop, look straight to the data center number. That's what we care about in this instance. What's changed during the quarter is that the next generation AI accelerator has started shipping. That is the GH200 or Grace Hopper superchip. It's in low volumes right now, but when they give that forward-looking guidance for the current period and then the full year fiscal 24, that's what the market will ask. How is your next generation chip gaining traction? And again, if China is a problem, Is the supply constraint meaning that you can level out that demand elsewhere? High hurdle to pass, 240% gain year to date. We're softer by 0.8% in the session, but the point being we closed yesterday at a fresh record high. Exciting.
The main event a little bit later. Ed, thanks for that. I've talked about this all morning. We've raised the bar every quarter for this company, and so far we've knocked out the park every quarter in reports. Going back to May, that first quarter, those earnings that came out in May just completely changed this market and the fate of this stock, up by more than 240% year to date. Emily, I've gone over the numbers that come out of SocGen, who basically said if you strip out the performance of the 20 AI boom stocks, the S&P 500 is flat. How dependent are we on these numbers that come out later?
Yeah, John, I think it's important. And again, you know, we've been overweight the tech sector. We find companies that are much higher quality. They have better balance sheets, great return on equity. So again, I think it makes sense to own these names and for investors to pay up for them. But we've got to think about looking where the baton is going into next year. We are seeing a huge shift in consumer behavior right now. You guys were talking earlier in the story about delinquencies picking up. We've got the resumption of student loan payments. We're clearly seeing a challenge to the consumer. Auto loans are at record highs. The credit card interest rates are around 25% right now. So we look to this environment where consumers maybe are not going to reach for that next purchase of the thing they want to buy. I don't know. My kids have some pretty intense Christmas lists going on here. They might be pretty disappointed, but they're still going to do the things that they need to do. So we think areas like healthcare, which has disappointed investors this year, even utility stocks, which have been crushed as yields have remained more competitive there, we think that the baton can be passed. We still want to own quality. We still want to own tech, but diversifying away from that in areas like healthcare and utilities, I think makes a lot of sense.
That sounds very defensive. Brian Levitt, I remember a line you used earlier this year. It was a number of months ago. You said to me, I'm a FOMO guy. Almost started laughing, but your fear of missing out meant you didn't miss out. When you hear things like defensive trades that Emily's talking about, Brian, what do you think?
Yeah, good memory, Jonathan. I appreciate that. I think there'll be a time for the defensive trade. I'm not there yet. You know, when I liken this to the so-called soft rally trade that we saw coming out of 2022 into the beginning of 2023, it was more risk on. And really what investors forget, everyone talks about how concentrated this market is. It was not concentrated over that period. It did not become concentrated until a couple of the banks started to fail in early March, and then the AI craze happened. And investors were very worried over that period that the Fed was just going to have to keep raising interest rates indefinitely. Some prominent people even using 6%, 7% as fear, as putting some fear out there into the market. So this is different. And, you know, I like peak inflation, which obviously happened 15, 16 months ago, but I like peak tightening and I like peak rates. And to Emily's point, you get a little bit of a weaker dollar in that environment, more of a risk on. So I'm not ready to get defensive. Again, we'll see the lagged effects of the policy tightening and we'll have to shift to quality, but I'm not there yet.
How many people called a 46% move in the NASDAQ 100 12 months ago, looking out 12 months? Just nuts. Brian, stick with us alongside Emily Rowland. The latest from Savita Subramaniam over at Bank of America. Here's her outlook. 5,000 by year-end 2024 on the S&P 500, so about 10% upside from today. Her line on the Fed: we're bullish not because we expect the Fed to cut, but because of what the Fed has already accomplished. We'll talk about the Federal Reserve in just a second. Let's get you some movers going into the opening bout. That open about 20 minutes away. Here's Abby.
Hey, John. Well, let's start out with the shares of Broadcom. They are falling. This as the chip maker has received a list of conditions it must meet to get approval from Chinese regulators in order for its $61 billion deal with VMware to go through. Other sovereign regulators have approved the deal. Best Buy down 4.3% after cutting their outlook on a quote-unquote uneven demand even before Black Friday. This after their third quarter same-store sales fell more than expected. Big ticket item sales really down. And then Bristol Myers Squibb fluctuating here in the pre-market after falling in sympathy with Bayer yesterday after Bayer stopped a late-stage trial on its blood-thinning drug on a lack of efficacy. Bristol Myers, on the other hand, has let Bloomberg News know, we are confident in our phase 3 Librexia program, which is unrivaled as the most comprehensive anti-FXAIA clinical development program today. Again, the shares of Bristol-Myers Squibb fluctuating in the pre-market, John.
Abby, thanks for that. Thanks for the update. More from Abigail around the opening bell. Coming up on this program, a final serving of Fed speak before Thanksgiving.
I don't think the committee is ready to celebrate quite yet that they've reached a sufficiently restrictive level. We've seen a lot of head fakes in inflation.
Fed Minutes coming up at 2 p.m. Eastern Time a little bit later this afternoon. That conversation up next.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The rhetoric from the Fed has been all over the place. We've seen Fed officials say that we're at the restrictive levels. Some Fed officials saying we need to remain patient and data dependent. We've also seen the chairman come out with a much more hawkish tone, pounding the table that we're not there yet. We're somewhat splitting hairs at this point. Whether we do see one additional rate hike or maybe the Fed is done, the notion of higher for longer, I think, is somewhat being lost on investors.
Investors gearing up for the Fed Minutes at 2 p.m. Eastern Time, looking for insight into Chair Powell's dovish remarks despite strong economic data heading into the last decision. Fed officials potentially noting downside risks, including more rapid labor market cooling, signs of slower credit demand, and a surge in longer-dated Treasury yields, which, of course, has since reversed. Mike McKee joins us now for more. Morning, Mike.
Good morning, John. Will the Fed Minutes be a turkey? They have been in the past because investors look to them for guidance and they haven't been getting it from the Fed. As the Lindsay Piegza comments noted, the Fed has been kind of all over the place, except that the markets have now taken that they are probably done. So on the left-hand side, the dot plot showing one more rise this year is probably no longer active. Would that be reflected in the minutes? That's an interesting question because at the time, as you noted there were a lot of different reasons for the Fed to think that they could raise rates because the economy was strong. So what is it that led them to hold rates where they were? You look at what had been happening with GDP and CPI. We've got obviously updates to those since the last Fed meeting, but they basically are betting on the fact that both of those lines will continue going down, that we'll see growth slow and inflation continue to fall. Can we get a reason for that? Can we get their thinking behind why they thought those lines would do that? What Wall Street really wants to know is what are the odds that either of those lines changes direction, and what are the criteria for raising or lowering rates? How long is longer and higher for longer, and when or if we land? Soft or hard landing? Those are the questions we'll be looking for answers to in the minutes, but the Fed is probably not going to give us a whole lot, which leaves us where the markets are right now, pricing rate cuts coming fairly soon in 2024.
Mike McKee, we'll see if we get some pushback a little bit later this afternoon. Mike McKee on the latest there, the Fed minutes out later. If you find this stuff really tedious, the Fed speak specifically, got some good news for you. Fed minutes and then nothing on the schedule as far as I can see on the Bloomberg terminal right now until a week today when you hear from Goolsby and Waller. Brian Levitt, Emily Rowland back with us for more. Emily, I want to share this quote with you from Citi's Andrew Honenhorst. In theory, these minutes could push against looser financial conditions, but we doubt they will, as officials have responded asymmetrically to tighter as opposed to looser conditions. Emily, do you agree with that?
Yeah, I think that's about right. And what we heard from the Fed in the November meeting was that the risk of doing too much versus the risk of doing too little is coming back into balance. And we think that makes sense. You know, the bond market is now pricing in a 100% chance of a hold in the December meeting. And the Fed, frankly, has a lot to be grateful for. By the way, I think we've been a little light on Thanksgiving analogies today, so I think we should go there. You know, we're seeing the labor market showing some cracks, but simply normalizing. We're watching it closely. You know, initial claims or continuing claims last week came in at the highest in about 2 years, but still some strength there in the jobs market. And then inflation is clearly moving in the right direction here for the Fed. In fact, it's probably going to continue to decelerate pretty rapidly here. We look at the shelter component, which is still driving 70% of the reading in core CPI. If you look at real-time measure of rents, we think that's actually quite a bit lower. So all the things are moving in the right direction, frankly, for the Fed, John. And that's the reason that we're seeing this kind of soft landing celebration in the markets right now. I think broadly investors have lots to be thankful for, in addition to the Fed inflation coming down, the Fed on hold, all good things, but it doesn't mean we should take them for granted. And we need to be careful here in terms of risk management going into next year.
I'm with you on claims. I think claims is the one in the coming weeks. Really, the one to watch, the one to focus on. Stuart Kaiser, also of Citi, just building on the work of Andrew Honenhorst, saying our view remains to be long equity unless and until the US labor and services spending shows confirmed weakness. And once you see that, to reduce risk quickly once that happens. Now, Brian, you're constructive. Let's go through this together. At what point do jobless claims start to concern you and lead to you ultimately changing your view on this market?
Well, should I join in the analogies too? So far, the Fed's making
Go
this
ahead.
look as easy as. So far, the Fed's making this look as easy as pie, right? The misery rate is very low in this country, but it's not going to last, Jonathan. We know that. There's always the lagged effects of policy tightening, and you know what you've seen in jobless claims is they've bottomed and they're starting to trend higher. It's not at a troublesome level. In fact, when you're in an economy that is too strong, you're not. You know, obviously it's human lives we're talking about here, but from a market perspective, you want to see a little bit of weakness there, and so we're trending higher. It's going to trend higher over the course of the coming months. So for the Fed, I think they're on hold here, and they say they're data dependent. They're waiting to see what they will have created for this economy after 550 basis points of rate increases in an incredibly short period of time. Things will start to slow, and you're starting to see even a little bit of dare we say deflationary impulses in the 1 year break even. It had been below 2%. So that's when they start to step away from it. That's a into 2024 story. But for now, it's a market that's quite enthused about, the low unemployment rate and inflation that's come down quite rapidly. And I really like Emily's point about shelter. It's absolutely spot on.
I guess, Brian, what I'm getting at, I'm not asking for a time on a calendar. I'm trying to work out what it looks like. At some point, there's a difference between a welcome loosening in the labor market and an unwelcome deterioration. It's something we've tried to get at through this week so far. Any idea of what that looks like, Brian?
Yeah, I mean, I think that starts to, I don't think we assess that until we're further into 2024. I mean, by the time by the time we get there, you will start to see some retracement in these markets. But ultimately, what I would say to investors is think about the multiple years after the end of tightening. Yeah, you're going to see some pullback as this economy slows. Ultimately, I think we're higher from here when that happens. But think about the subsequent years after that. Markets tend to do very well in the subsequent years after peak inflation, peak rates, and peak tightening. So we could have some challenges in here. Remember, the market fell 25% though in 2022 in expectation of some of those challenges. Don't be surprised if we retrace some of these recent gains. But ultimately, I think we're higher by the end of 2024 than where we are today.
Brian, thank you, sir. Brian Levitt, Emily Rowland, to the two of you, thank you, appreciate it, and have a happy Thanksgiving, guys, going into the next 48 hours or so. Over the next 24 hours, three-part act for this market. Act 1, Fed minutes, 2 p.m. Eastern Time. Act 2, after the close, a little bit later, you get NVIDIA earnings. Act 3, for me at least, and for many others, tomorrow morning, 8:30 Eastern Time, when we get initial jobless claims data. They're the three things to watch on the calendar as things stand. Equity futures going into the opening bell about 7 minutes away. We're slightly negative here. We're down 1/3 of 1%. Coming up, the morning calls and later, Treasuries erasing their yearly declines. AB's Gershon Distenfeld joins us with his outlook for the year ahead. Your opening bell, 7 minutes away.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He
story.
is there to kind of upside.
Okay, 5 minutes away from the opening bell. What a run in this market. The S&P 500 5-day winning streak. The Nasdaq a few percentage points from all-time highs. That's the price action right now, pulling back just a touch. Let's get you some morning calls. First up, Citigroup downgrading Zions Bancorp to neutral, seeing downside risk to consensus earnings estimates. That stock down 1.5%. RBC Capital downgrading Hershey to sector perform, expecting a tough year due to mounting competition and macro headwinds. And finally, BTIG downgrading Foot Locker, recommending investors move to the sidelines ahead of next week's results. That stock just a little softer by 1/3 of 1%. Coming up, retail earnings missing the mark, fueling concerns about the state of consumers. That conversation up next with AB's Gershon Distenfeld. That's next, your opening bell, just around the corner.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. 5-day winning streak on the S&P 500, about 25 seconds away from the opening bell in New York this morning. Good morning. State of play, Microsoft, record high. Nvidia, all-time high. The Nasdaq 100, a few percentage points away from a record, starting today at a 22-month high. There's your opening bell. Switch on the board and get to the bond market. Yields look like this. Lower by a single basis point. 440.81 on a 10-year. My focus, shifting to foreign exchange. The euro, 4 days of strength, 4-day winning streak on the euro against the dollar. 109.56. That's the longest daily winning streak going back to July. The currency pair, the highest since mid-August. 109.56 and positive there by 0.15%. Turning to crude, we're negative here by 0.6%. WTI at the moment, $77 and about 32 cents. About 30 seconds into the session, equities on the S&P 500 pulling back just a touch. We're down 0.25%. The Nasdaq down by 0.5. One stock to watch at the open, Lowe's. The retailer cutting its annual forecast, echoing Home Depot's concern that a slowdown in big-ticket spending will likely weigh on holiday sales. Abby has more. Hey, Abby.
Hey, John. And the stock right now heading to its worst day in about 2 months on that outlook being cut. Plus, the quarter that was reported was not stellar. It was basically in line, a small miss. Sales of about $20.47 billion, missed estimates by 2%. They put up adjusted earnings of $3.06. That was a slight miss. And the same-store sales declined for a 4th consecutive quarter, coming in at down 7.4% versus the estimate of 4.9%. So all of that setting the stage for then cutting the outlook for a second time this year. The company is talking about what you just said, big ticket sales, not as robust as they had been, as you mentioned Home Depot, and we also were talking earlier about Best Buy saying something similar. They're also saying that there's a slowdown in do-it-yourself demand and discretionary spending. So for the full year, Lowe's now sees same-store sales dropping 5%, worse than its prior expectation of a range of down 2 to 4%. It's interesting. Some analysts are saying that Lowe's numbers are a little bit less impressive than Home Depot's on the year. Both stocks down just about slightly.
Had some shockers in retail this morning. We'll talk about more of those in just a second. Abby, thank you. Just to touch base with the price action once again. A couple of minutes into this, we're down by 0.25% on the S&P 500. 5-day winning streak into this, but big earnings report coming out a little bit later from Nvidia. Sticking with earnings, Baidu topping Q3 revenue estimates and reiterating AI investment plans to help drive future growth. Ed Ludlow has this story. Hey, Ed.
Yeah, good morning, Jonathan. So Baidu's down a percentage point on its US-listed shares or ADRs following the open. In pre-market, they had been as high as 1%. Overall, in terms of the financial results, basically in line with expectations. Overall, this is a Chinese technology company that is seeing pretty sluggish growth, but is able to extract some upside on the bottom line. The AI story is that Ernie, its generative AI tool, chatbot, akin to OpenAI's ChatGPT, is giving some support to the top line. Sales grew by around 6% to $4.8 billion from July to September, slightly ahead of expectations. And the narrative from the company is that Ernie, the chatbot from Baidu, is going to add some real top-line support in the coming fiscal year. There is a fierce battleground in China in the AI context. I think we know that. We talk about that. But in terms of taking that underlying technology, building large language models, creating a generative AI tool in the form of a chatbot, Baidu is giving some evidence that they're able to monetize that. And, you know, just like many other technology companies in this country, there is softness in Baidu's advertising business. And so this top-line support, I guess, from the AI product is doing some work to offset that.
Thank you. Stock down just a touch. We're negative here by 1.4%. No drama there. Let's turn back to retail results. Coles under pressure after reporting a 7th consecutive drop in comparable sales, pointing to weakening foot traffic and a shift away from consumer spending on discretionary goods. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, and CEO Tom Kingsbury was just on the earnings call just now. Softer than expected demand environment. That is what he was talking about. In the third quarter, we saw comparable sales down 5.5% on a year-on-year basis. The expectation had been down about 3.5%. Talking about a decline in foot traffic. Kingsbury also saying he doesn't like to blame anything on the weather, but then going ahead and blaming bad weather in the Midwest, Mid-Atlantic, and Northeast regions for some of that. That said, the company, as we've seen some other retailers do, was able to outperform on the profit side. Third quarter earnings per share coming in at 53 cents versus the 36 cents that Wall Street had anticipated, and seeing earnings near the top end of their previous expectations for the full fiscal year, bringing up the bottom leg of that guide. It's able to, seeing some positives on CapEx as well. It's undertaking a massive store refresh, building out its partnership with Sephora, but does believe that the money needed to do that will only be on the lower end of the 600 to 650 million that it was anticipating. Yesterday, however, we did get the announcement that the president's COO was out after just about 9 months. Bloomberg Intelligence saying that the silence on this has been awkward, also pointing out that the turnaround may take longer than expected, but this call is ongoing, so we'll see if we get any more details there in the coming minutes.
Getting hammered. We're down by about 9%. Simone, thanks for that. 22.64 in early trading. I said there was lots of bad news out there for the retailers. There's one bright spot. This from Dick's Sporting Goods. The stock is up by a little more than 8% this morning. That's probably a rare bright spot out of the retailers in the last 24 hours, boosting their outlook. Things look okay. Best day since March, potentially, for Best Buy, for Dick's rather. We're positive there by about 8%. Let's get to the bad news for the retailers. I mentioned Best Buy briefly then. Let's talk about it. Cutting its full-year sales forecast due to uneven demand for consumers ahead of the holiday shopping season. Katie Greifeld has this. Hey, Katie.
Best Buy currently down by more than 5% after missing estimates, cutting the outlook. Now, same-store sales, they fell more than expected. And remember, we saw a similar thing from the likes of Macy's, Target, and Gap just in the last couple of weeks. But unlike some of those other retailers, Best Buy isn't expected to preserve its profitability to the same degree. To go through some of the numbers here, sales this fiscal year now seen at $43.7 billion. That previous guidance was for $44.5 billion. Best Buy also lowered the high end of its adjusted EPS range by about 10% to $6.40. And like you said, that's really being driven by what Best Buy says is uneven consumer demand. Big ticket items seen as especially weak. That is similar to Lowe's, and the chain also noticed softness when it comes to home theater and computing. You add it all together, and it's a pretty grim message going into Black Friday, John.
Katie, thank you. The stock is down by, let's call it 5% in early trading. We're about 6 or 7 minutes into the session. Broader markets down about 0.25%. On the S&P, on the Nasdaq, we're down about 0.4%. If you want to turn to the bond market just briefly, it was what didn't happen yesterday. No bad news for the 20-year auction, which meant this bond market was supported just a touch. Yields came in just a little bit. On a 10-year, we're down by about a basis point. 440 on a 10-year. 30-year yields coming in, not even a basis point this morning. 456. Looking at a 2-year, down about 3 basis points. 488. This from Gershon Distenfeld of AB, weighing in on the Fed's road ahead. In the Fed's own words, there's still a long way to go, and progress remains slow. They may be done hiking, but they aren't anywhere near cutting either. Gershon, I'm pleased to say, joins us right now for more. Gershon, with that in mind, looking ahead to this afternoon, 2 p.m. Eastern Time, what would you expect to hear from the Federal Reserve minutes?
You're going to hear a lot of balance, like you've heard the past few times that you've heard from the Fed. There's really nothing new here. They're trying to figure out, does it make, what's the future path going to be? And then we all sit there and look at, we look at the employment prints every month, we look at CPI, we look at manufacturing surveys, we look at all sorts of things. But they're trying to figure out where the puck is going. And the truth of the matter is, they don't really know. Right? Monetary policy, as we've spoken about many times before, has a huge lag to it. There's been a lot of tightening of financial conditions. We're starting to see some cracks there. At the same time, that inflation is coming down, but not nearly to the level that the Fed wants it to. So the Fed's just not sure. If you ask them honestly, they don't know what they're going to do, but it's probably going to take some time to sort it all out.
I know there's a couple of relationships that you've been following, and you've kept us up to date every time we've talked about them. I've identified the two you often talk about, the relationship between the ISM and bond yields and Fed funds. Gershon, which of those relationships do you think is most relevant right now?
Look, I think in the long run, they're both relevant. I think that, as I've said many times before, this idea, we're going to see the 10-year, let's say, probably bounce in this 4 to 5% range. It's just not that. It's supported by the fact that, the Fed's admitting that they may not get back at 2%. Let's say they get 2.5%. Real rates, I heard a guest earlier said real rates should come down 100 basis points. I'm not sure. I think 200 has been the average of the past 100 years. So kind of a mid-4s on rates it makes sense. The forward curve is now pricing in that the Fed only cuts to 4% and then kind of stays there forever. So I think we're in a new regime. Just like we were in a regime of very, very low rates for many years, I think we're in, I wouldn't call these high rates, but kind of mid-level rates is what we're likely going to see in the coming few years.
Well, you've got two choices. One, stay in cash, or two, stay fully invested. Gershon, based on the price action of the last couple of weeks, is it the latter that you'd lean towards just a little bit more?
Look, I think you should always be fully invested. The reality is, unless you think that cash has a higher expected return than other assets, over time, you're going to do a lot better in other assets. So we believe at AB that all the time you should be fully invested. It's very, very hard to time these markets. And yeah, the price action of the past few weeks shows that, a couple weeks ago, everyone thought the world was falling apart. And now, of course, people think things are much better despite some of the retail weakness that we've seen. So investors, they come and go in terms of their emotions. But, we believe one should be fully invested.
Gershon, right now, spreads look tight. On my screen right now, high yield spreads are back to about 383. When you're having these conversations with clients, you're focused on spreads? Are you focused on overall yield? What are the conversations sounding like at the moment?
I think the conversations are a lot around default because there's a lot in the media out there that the default rates are likely going to be high in the next few years. And actually, we agree with that. But what I think, we've been explaining to clients, I think that market participants are missing is that high defaults do not equal low returns. You look no further than 2009. You had 10% defaults and a 60% return. And the reason was the defaults were already priced into the marketplace. So you look at today, you have about 10% of the high yield market trading at a dollar price below 60. If all of that defaults over time, just not the biggest deal in the world. Something trading at 45 and defaults and recovers somewhere between 40 and 50 doesn't have any impact on the marketplace. And in fact, a bond trading at 50 cents a dollar with, let's say, the average 8% coupon, that's giving you a 16% yield while you wait. You might still get a few coupons. So you could have very high defaults and still very strong returns in credit markets. And that's kind of what we're expecting. We're expecting higher than average defaults. We expect them to be in the area that's already priced into the market. If there are a lot more surprise defaults, meaning defaults in bonds that are not priced if they're going to default, yeah, that'll have a bigger impact in the market. But we certainly think you can get high defaults and high returns, and that we still believe credit on a risk-adjusted basis is a lot better place to be than the equity markets.
I want to talk about that, Gershon. I've heard you mention many times over the last decade that you and I have talked about credit markets, drawdowns in equities versus credit in recessions. Gershon, can you go through that again?
Yeah, it's actually not just in recessions, John. It's any time. I'm not cherry picking here. Every single time high yield has had a drawdown of 5%. I'm not picking monthly returns or anything, an actual drawdown. Every single time equities has done worse. Now, of course, equities do a lot better in the long run. And for long-term investors, equities are going to return more than high yield. But one has to be, you know, on a risk-adjusted basis, we think that the high-yield market makes a lot of sense for most investors.
The one worry that I think other people have as well, outside of, say, rising default rates, Gershon, you hear a lot about the maturity wall out there in 2025, that these companies will try and get ahead of that. They need to come to the market and issue debt. Is that something you're concerned about? Should we be concerned about it?
Well, I think that's a perennial concern of the high-yield market. I've been hearing it throughout my whole 25-year career. You know, the high-yield market is set up so that you're always going to have a maturity wall because most debt becomes callable 3 to 5 years before maturity. The reason it's a little bigger concern today is because the numbers are higher, and the reason is not because of stress in the market. The reason is purely based on rates. So companies, you know, historically, because, you know, yields have gone down and companies that don't default end up being higher credit quality on average, it's almost always been economical for companies to call their debt early. In other words, I had a 9% coupon, I can refinance at 7%, that's a no-brainer. Well, today it's the opposite. You have a lot of companies that very smartly termed out debt at 4 and 5% a number of years ago when yields were very low. Now, that debt is callable, but the price in the marketplace might be 6 or 7%. So what does the company do there? Do they swallow, for liquidity purposes, kind of swallow that extra 100, 200 basis points? Or do they kind of gamble a little bit? I think the higher the cyclicality of a company, the more dangerous it is to gamble on that. But that's something we certainly have to watch. It's a little bit of bigger concern this time. But again, it's not due to any credit concerns that the market can't refinance these companies, simply due to the higher refinancing costs for companies in today's market.
It's a focus for us all going into next year. Hey, Gershon, happy Thanksgiving. It's good to catch up with you, buddy.
Happy Thanksgiving.
Always is. Thank you, sir. Gershon Distenfeld of AllianceBernstein. Coming up on this program, another chapter in the OpenAI drama.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
OpenAI investors pushing for the return of Sam Altman, the company scrambling to avoid a staff exodus. That conversation up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
The board has not talked about anything that Sam did other than some breakdown in communications. And, I've not directly was told by anyone from their board about any issues. We definitely will want some governance changes. So that, surprises are bad. And we just want to make sure that things are done in a way that will allow us to continue to partner well. We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
Satya Nadella looking ahead as OpenAI goes into damage control mode. The startup reporting intense discussions underway to quell a potential staff mutiny. Roughly 95% of employees threatening immediate resignation, citing this: "Your actions have made it obvious that you are incapable of overseeing OpenAI." Silicon Valley responding the only way it knows how, on social media. Salesforce CEO posting an offer of immediate employment and pay match to any disgruntled OpenAI expats. Your team coverage starts right now. Ed back with us in San Francisco, Mandeep Singh in New York City. Ed, what is the state of play this morning?
Yeah, the state of play is that both from sources, but also you can see in posts on X, the majority of those OpenAI staff are staying for the time being. They are highly confident that Sam Altman can return, and that right now there is no point in defecting to Microsoft. I'll get to Salesforce in a second. The latest kind of hard piece of news is that Anna Mankaju, who's the global affairs chief, sent out a note overnight saying that the company's leadership are in intense discussions with Sam, with the board, to make something happen. The board is digging in. The attitude towards the offer from Salesforce, but to an extent Microsoft as well, is thank you but no thank you. That many of those sort of data scientists and engineers think that the best option is to dig in, stay with OpenAI, because ultimately that would lead for them and for Sam and for the company the best outcome.
Mandeep, a lot of people said yesterday, big win for Microsoft, another great win for Satya Nadella. Mandeep, you didn't share that view. Has your view changed?
No, and in fact, the longer this thing takes to solve, I think you are going to see the team getting disintegrated. And look, at the end of the day, the outcome is driven by what happened. And nobody exactly knows what transpired. Yes, there wasn't communication between board and Sam Altman, but at the end, there is a concern around the safety issues, probably some IP infringement issues in terms of training the model. And I just can't see how those get resolved without, the truth coming out. So clearly, Sam going back to OpenAI is the most likely option, but I can't imagine the team, continues to operate the way it was. And, them getting to GPT-5 before anyone else does in terms of the competition, which is Google and Anthropic. And you could already see some customers considering, moving to these alternative large language models.
So Mandeep, you're telling me they're not just losing staff, personnel, they're losing customers?
Yeah, and look, this company was expected to do $1 billion run rate this year, and some of it is, subscription revenue from consumers. Other majority of it is related to enterprise relationships, and those enterprises which were using OpenAI as, the kind of the foundational large language model instead of building their own. are going to rethink their strategy as opposed to, building on OpenAI versus building on these competitive platforms.
This has been a total mess now for days. Ed, in Nadella, we have one of, if not probably the best CEO in corporate America, given his track record over the last decade. Ed, this is not how he does business. Did you sense with Emily Chang that this was a frustrated man in that conversation?
Thank you for bringing that up. I think it's critically important that he didn't answer the question on his position on how he feels about Sam going back to OpenAI. His answer was he's committed to partnering with Sam irrespective of where he is, Microsoft or OpenAI. Surprises are bad was the quote, very telling. But the key piece of news from that interview is that he does want to see corporate governance and board changes at OpenAI. Whatever happens from a sort of talent or personnel perspective with Sam, Microsoft still has 49% of that business. So it has a financial consideration around this. But just to answer Mandeep's thing on losing customers, Microsoft has airtight licenses to use the current generation of GPT and offer it as the technological underlying embed for all of its own technology. So right now, it's sitting pretty in that sense. It's just a case of like the future. And yes, he doesn't do business that way normally.
Clearly not. Ed, thank you. Ed Ludlow, Mandeep Singh, to the both of you, fantastic coverage. To the whole of the tech team over the last weekend and the last couple of days as well. Your price action in equities right now looks like this on the S&P. We're down about 1/4% on the S&P 500. On the Nasdaq, we're down about 0.5. I'll bring you the calendar for the next 24 hours up next. Your trading diary, just around the corner.
do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
26 minutes into the session, pulling back just a touch, snapping a 5-day winning streak on the S&P. We're down about 1/4%. That's the price action. Let's get to the trading diary. Coming up over the next couple of days, the FOMC minutes coming at 2 p.m. Eastern, followed by NVIDIA earnings after the closing bell. On to tomorrow, jobless claims and durable goods coming tomorrow morning, 8:30 Eastern time. Thursday, US markets close for Thanksgiving, and markets closing early on Black Friday. That gets you to the weekend from New York City. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Well, the OpenAI story continues to evolve. Last evening, Bloomberg's Emily Chang sat down with Satya Nadella, the CEO of Microsoft, to get the latest. We'll bring you some of those comments. Just fascinating discussion there, so we'll bring that to you. Plus, Dan Ives, he's going to join us right after that. He is the senior equity analyst at Wedbush Securities. Get his thoughts on this whole OpenAI issue, what it means for Microsoft and for the tech space going forward. And then our good friend Ira Jersey, chief U.S. interest rate strategist for Bloomberg Intelligence, will join us and give us a sense of where rates are going, where our good friends at the Federal Reserve, kind of how they're going to play this thing going forward. But first, let's kick things off with Mr. John Tucker of Bloomberg Business Flash.
All right, Paul, we are data dependent, so let's start there. Just getting existing home sales, let's call them used home sales. Month over month, they're tumbling down 4.1%. From 2% the prior month. The expectation from economists surveyed by Bloomberg was negative 1.5%. But again, coming in 4.1% lower for used home sales. Right now, you have the S&P 500, the Dow Jones Industrial Average, and the S&P 500 all lower. In the broader index, the S&P 500, 9 of the 11 major industry groups, they are lower right now, being led lower by energy, information technology, and consumer discretionary stocks. S&P 500, 12 points lower right now. Also, retail giant Best Buy tumbling after cutting its full-year sales outlook. Cameron Dawson at New Edge Wealth says a lot today is going to be riding on NVIDIA's earnings results. We get those after the close today.
Now, we would expect from NVIDIA still that very bullish outlook about the promise of AI, but how much are they able to continue to really be able to surprise to the upside on earnings, which I think will be really important as we go into 2024, because that's when we see their earnings growth decelerate a lot.
And 2-year yield right now 3 basis points lower, 487. The 10-year is down 2 basis points after those home sales figures, used home sales figures. Right now 439 on the benchmark. Again, the S&P 500 11 points lower. That is down 0.25%. The Dow down 69 points. NASDAQ 100 88 points lower. And Bloomberg Economics says the minutes of the Fed's last policy meeting, we get those at 2 o'clock Eastern, will show the FOMC's concern about downside risks. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Bailey and Paul.
That's
Hi,
right.
Bailey.
John Tucker, thank you so much. Bailey Lipschultz sitting in for Matt Miller, because I guess, Bailey, this means that the paternity leave from Mr. Matt Miller has begun, I guess.
That's what I've been told. Eric
Okay.
messaged me saying
Do we have
baby
like
was on
news from the home front specifically?
No, but I've been told something. We should expect something later today. So anyway, this could be the long extended 6-month paternity leave for Mr. Matt Miller. So we got got Bailey sitting in for us. We all know Bailey. He covers all the markets for Bloomberg News, so he'll keep us company here. So we're stuck here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So go over to youtube.com and search Bloomberg Radio. Well, we continue to follow the saga of OpenAI after the ouster of co-founder Sam Altman. Yesterday, Microsoft Chief Executive Officer Satya Nadella joined our Emily Chang to discuss Altman joining Microsoft, its partnership with OpenAI, and goals for artificial intelligence. Let's bring you part of that discussion right now.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are. And, I think about Sam has chosen multiple times now to work with us, and that's fantastic to see. And I think the real thing is that the capability that Microsoft has across the tech stack is what attracts great people like Sam, and people like Sam and, innovators like Sam when it comes to AI to come to us, and we're thrilled about it.
You incredibly quickly hired Sam as well as Greg. We are hearing that Sam wants to return. Investors want him to return to OpenAI. How would you feel about that?
Yeah, as I said, we really want to partner with OpenAI, and we want to partner with Sam. And so irrespective of where Sam is, he's working with Microsoft. And that is the case on Friday, and that's the case today. And I absolutely believe that that'll be the case tomorrow.
So what are the conversations you've had with OpenAI's current board? From their perspective, where do things stand? And have you talked with Emmett Shear, the new interim CEO?
Yeah, I've had conversations with Emmett. And again, it's the same thing. There's no real difference there from where we were when we were working with Mira and she was interim CEO, when Sam was CEO, and Emmett. So my message to them, Emmett, is very clear, which is, hey, look, we remain very, very committed to OpenAI and its mission and its sort of roadmap, and they can count on us. And then, as I said, we are also very committed to Sam and Greg and team that want to join us. If they're not at OpenAI, or anyone else who is at OpenAI wants to go somewhere else, we want them to come to Microsoft and continue to work here and in partnership with OpenAI.
To your knowledge, why was Sam fired? And to your knowledge, was he involved in any wrongdoing? Has the board given you a reason?
As far as I'm concerned, we were, as I said, we were very confident in Sam and his leadership team. I've not been told about anything. They published internally at OpenAI that the board has not talked about anything that Sam did other than some breakdown in communications. And I've not directly was told by anyone from their board about any issues. And so therefore I remain confident in Sam and his leadership and capability. And that's why, we want to welcome him to Microsoft.
Now, we understand that to support a return of Sam Altman to OpenAI, Microsoft wants some changes to the board, to governance, to its overall contract with OpenAI, so something like this never happens again. What specifically are you looking for? For example, would you want a board seat? And if not, what else?
Yeah, I think we definitely will want some governance changes so that, surprises are bad, and we just want to make sure that things are done in a way that will allow us to continue to partner well. That's about it, right? This idea that somehow, suddenly changes happen without being, in the loop is not good. And we will definitely ensure that some of the changes that are needed happen. And we continue to be able to go along on the partnership with OpenAI.
All right, that was Bloomberg's Emily Chang. Last evening, she was interviewing Satya Nadella. He's the CEO of Microsoft, and just about what's happening on this whole open AI. I've just never seen anything like it, Bailey. I mean, here's a company that had a valuation, presumably of about $86 billion, and they fire their, this visionary leader with very lack of clarity, and then now they want to bring them back, and they got, most of the employees are, staging a mutiny here. I've never seen anything like it.
Yeah, it's almost like they pulled the plug on their own operations. I remember being in here with Scarlett on Friday when the news broke, and the way the release was written was so confusing about him not being forthcoming, just very odd all around.
Very odd, and I actually think it's a huge black eye for Silicon Valley. That's just my East Coast bias, probably. But let's check in with Dan Ives. He's a senior equity analyst at Wedbush Securities. Dan, you follow Microsoft closely. You follow the tech space as closely as anyone else out here. We've had a few days here to kind of digest what is a very fluid situation still to this minute. What are some of your takeaways here?
I mean, if you have a clown show that runs the board, this is what happens. And essentially, this is 4 individuals that took down a $90 billion company. And I think when you look what happened over the weekend, they were essentially like 7-year-olds playing checkers at the kids' table. And then Nadella, the grandmaster chess wizard, basically was 3 steps ahead, took Altman. Now, essentially, this is a shell company where all the assets essentially moved to Microsoft.
And is it all a surprise that Altman so quickly? It seems to me, it makes sense, but it seems like very swift move for Microsoft to swoop in and snag Altman that quickly.
Well, Altman's the golden child of AI. I mean, no different than Zuckerberg to social media, Musk to electric vehicles. He was the asset, and of course, him, Brockman, and some of the top leaders. The last thing that could have happened, the worst case would have been them going to an Amazon, a Google, an Apple, because there's just massive, massive demand for these assets in terms of not just them, but the 700 OpenAI employees. And look, this is a board. I mean, they're going to be dealing with legal issues for probably, the next decade because of this. But the reality is they took down a $90 billion company by themselves.
With a little bit of hindsight, Dan, do we know why they did what they did? What was the core issue here for the actions on Friday?
I mean, Paul, you hit on it. It's typical 408 Valley, where they, whether it was egos, political, not communication. I mean, Altman became the face of AI. It's a board that probably felt slated, obviously went back and forth. And then I do think they underestimated the ramifications. I mean, even when you look at Eli, chief scientist, co-founder, one of the 4 voted was key in getting them fired. Then all of a sudden yesterday morning says, oh, he actually regrets it. Paul, that's literally like burning someone's house down and then the next day coming with a Hallmark card and a piece of chocolate saying, I'm sorry.
All right. So one of my issues, or one of my questions, I guess, Dan, is, I mean, Sam Altman and others are obviously key to this whole AI technology, but doesn't the intellectual property reside at OpenAI? Doesn't the entity control it and have most of the value as opposed to what's behind or what's between Sam Altman's ears?
Before Microsoft, yes. After, no. I mean, now essentially that technology is baked into Microsoft's ecosystem. And that was part of the deal, even though it's 49%, if you look how Microsoft actually structured the deal, I mean, OpenAI, that technology is essentially embedded in Microsoft.
Okay.
That's why they recognize that the value of OpenAI is basically what goes up and down the elevators. If they come to Microsoft, that OpenAI essentially is a board with a third-rate interim CEO, former Twitch, and that's it. And now they'll just be spending all their time with lawyers.
And Dan, what happens next? And how do you incorporate Sam Altman into your valuation of Microsoft? Stock was up 2% yesterday, but is not really continuing to add to those gains.
Look, I mean, when we went to bed midnight Sunday, I mean, Microsoft could have been down 8-10% if Nadella didn't swoop in, because that was the fear. Now it's essentially, I'd say Microsoft's in a stronger position today. You saw the reaction yesterday than it was on Friday. It's a win-win. Because either way, the legal, the global pressures, the board, their lawyers, they're going to resign. Then it's actually a better situation than it was before Friday because you don't have a JV circus show board there blocking things. And then if they just sit there, then they'll all just go to Microsoft and it's essentially a shell company. But it goes back to they were playing checkers like 8-year-olds. Nadella was playing chess.
So do you think Sam Altman, I mean, I don't know him. I haven't even seen him interviewed. There's a guy, I mean, for us who aren't tech folks, really under the radar. Can he work, and can these people work in a big corporate organization like Microsoft? Can he report to somebody, some other executive, whether it's Nadella or someone else?
Oh, it's a great question. And in Microsoft, I mean, they're very well versed in doing this in terms of almost an entrepreneur atmosphere in that Redmond headquarters on campus. Just leave them alone, do what they do. I mean, it's similar to the success they've had with LinkedIn and other assets. That's part of that DNA in Microsoft, which speaks to why Altman and Brockman signed up so quickly. And now, either way, it's a win-win for Microsoft. They are positioned for, and Nadella, just a phenomenal PR, show yesterday, because that's just putting more and more pressure on the board. Because whichever which way it happens, it's a win for Microsoft.
Yep. So Dan, from your perspective, what do you think is a better structure for this AI investment in technology to continue to flourish? Is it for Sam to go back and his team to go back to OpenAI with a revamped board? Would that be better than sitting within the halls of Microsoft? How do you think that should play out?
That would be Goldilocks. You get rid of the 4 circus show board members. Then you put in Brett Taylor, Marissa Mayer. You have someone from Microsoft, a legit board. Governance is there. I think that would also give comfort to the Beltway, just given how important this technology is. And then they go back, it's actually better than before. That's the ideal situation. That's what everyone thought was going to happen Sunday. And then it just turned into what's going to be an infamous, probably a Netflix documentary at one point in terms of what happened here.
And you mentioned Altman could have gone to Amazon, Google, Alphabet, and others. How does this move impact those companies and their ambitions within AI?
Off yesterday, basically offering to match any offer out there for AI engineers. I mean, there's massive, massive demand. Call it 50x for every one employee. Google, Amazon, they're going to be aggressive trying to get assets because of this air pocket. Look, it definitely gives them a window that they could gain some share, get some engineers, get some developers that maybe they couldn't have gotten before with significant pay packages. This is going to be, a frenzy. Look, right now, if you're an AI developer engineer in the Valley, I mean, you're probably drinking mimosas in the morning.
So, Dan, I mean, just again, I'm an old school East Coast Wall Street guy. It's almost embarrassing for Silicon Valley. I mean, I would almost be like, God, this past 4 or 5 days makes us look like a bunch of kids here. What are you hearing out there?
That was what we heard over the weekend. I mean, from people, very close to the situation. It's an embarrassment. It's a historical embarrassment. And it just shows what happens when you don't have adults in the room and some of these political sort of back and forth. This is what happened. But that's also why you need the Nadellas and Microsofts to basically swoop in and make sure that this goes no further. And that's why right now the board backs against the wall. They're probably on their phone with the lawyers the whole day.
Exactly. All right, Dan, thanks so much for joining us. Really appreciate it. Just been an extraordinary story there. Dan Ives, Managing Director, Senior Equity Analyst at Wedbush Securities, kind of giving us some of the latest here. So, I mean, this isn't done, I guess, Billy. I mean, we still have to figure out where Sam Altman and his team will reside going forward, whether it's back at OpenAI with like a new board, as Dan was suggesting, or whether they stay at Microsoft. And such a Nadella, with his conversation with Emily Chang, says either way is fine with us.
And that seems to be what Dan's saying. No matter what Microsoft wins, and the read across to would-be competitors is that they have a small window, but time's ticking.
Quick, potentially stupid question, but the stuff that OpenAI has, is that proprietary? Even if the whole staff leaves, can they take that with them?
Yeah, and what I asked that to Dan, and Dan was kind of like, hey, it's that technology is already pretty well embedded within Microsoft's products already. So yes, I'm guessing there's, intellectual property that is the property of OpenAI, but it's been so well enmeshed into the Microsoft product that it's almost a moot point. So we'll have to see how that plays out, but presumably there is some value there at OpenAI that you'd like to, I guess, kind of recoup or preserve going forward. So we'll see how this plays out. Still a fluid situation, and for those in technology, it is big, big news. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. Shares of Lowe's, they are falling. They're down about 2% right now. And this is after the home improvement retailer reduced its full-year revenue forecast again. Same-store sales, they fell in the third quarter. That's the fourth decline in a row. Bloomberg Intelligence's Drew Redding explains why.
I do think that the consumer is under greater pressure than we've seen over the last several quarters. It's the pullback in discretionary item. Think of things like floor and cabinetry, appliances. Another big piece of this is think about how much Lowe's grew sales during the pandemic. They grew sales about 30% during a 3-year period, so about 16% annualized. And that compares about 5% in any given year.
Now, Redding says that pull-forward demand is now starting to give back. Kohl's is under pressure after reporting a 7th consecutive drop in comparable sales. Bloomberg's Simone Foxman has results from the earnings call with CEO Tom Kingsbury.
In the third quarter, we saw comparable sales down 5.5% on a year-on-year basis. The expectation had been down about 3.5%. Talking about a decline in foot traffic, Kingsbury also saying he doesn't like to blame anything on the weather, but then going ahead and blaming bad weather in the Midwest, Mid-Atlantic, and Northeast regions for some of that. That said, the company, as we've seen some other retailers do, was able to outperform on the profit side.
Shares right now, they're down 13%. And teens just love their Abercrombie & Fitch, and moms and dads got to pay for it. The retailer posted better than expected third quarter earnings and raised its guidance after a strong back-to-school season for its Hollister brand. Shares of Abercrombie & Fitch, they're down about 8%. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks that may be priced for perfection face another test after the close. That's when NVIDIA reports results. Ahead of that, the major indexes, right now all lower. You have 8 of the 11 major industry groups in the S&P 500. They're down. $6 trillion in market capitalization. That's been added to the S&P 500 so far since the start of this year. Right now, the S&P 500 down 15 points, we'll say, down 0.3%. 45.32 on the index. The Dow Jones Industrial Average is 69 points lower. NASDAQ 100 right now, 117 points lower. That is down 0.7%. We're seeing yields lower. The 2-year is down 3 basis points. That is at 4.87. The 10-year yield, 2 basis points lower at 4.39. Treasury market getting a boost after that successful auction of 20-year debt that we had yesterday. And data, soaring mortgage rates, stubborn prices, discouraging buyers and sellers alike. Sales of previously owned U.S. homes falling by the most in nearly a year in October. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate it. It's Bailey Lipschultz and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. When you think about the Treasury market, I mean, 2022 double-digit declines, across fixed income in general in 2022, just brutal. I'm looking at the Bloomberg Treasury aggregate index this year. It is literally unchanged. So 2 years, nothing. There's an analyst out there, and I'll keep him nameless, who's saying Treasuries are set up for 2024 double-digit rally. Big call.
Big call.
You want to talk to this guy?
I'm interested in what's going on.
All right, Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. He joins us here. All right, Ira, can I make some money in Treasuries anytime in my future here?
Yeah, well, the fact that we're at zero this year when we had been down 6-7% earlier in the year, I think is reasonably telling as well. And that wasn't that long ago. Keep in mind, in September, when 10-year yields hit 5%, the Treasury market was down quite a lot for the year. It looked like we might have had the third negative total return year in a row, which is completely unprecedented. So, yeah, I do think that we could get double-digit returns. That is predicated on a pretty slow economic forecast from our economics team at Bloomberg Economics, and inflation remaining above the Fed's target but continuing to meander a little bit lower. So I think those things can combine to mean that we can wind up with a bit of price appreciation. Plus, of course, today versus the last decade, even if prices do nothing, you're still going to make 4.5% in 10-year Treasuries. So that's not a terrible return, assuming there's alternatives that don't do as well either.
So people are actually going to take a meeting with you, like when you go up to Boston?
Yeah, so I've had a lot of people wanting to talk about our 2024 outlook for sure. Since we put out that call, some people are pushing back, right? There's some people who worry about a reacceleration of inflation next year. Some people who think that growth is going to remain good because the employment situation is good. We take the other side of that, and not necessarily thinking the economy is going to be a disaster next year, but just that with somewhat slower nominal growth, so both inflation and real GDP being a little bit lower, you can have decent returns in the Treasury market. And we're still not talking about going back to 1% Treasury yields, right? We're talking about going to 3.5%. So it's not like we were there earlier this year. Just for context, in March is where we're talking about going back to where we were in March of 2023.
Ira, I'm looking on the WIRP function. We've got pricing into options. First rate cut in June, 3 by December. Why is that what the markets is implying versus what you're expecting?
Yeah, I think the market's getting a little bit ahead of itself. I think the market believes in general that we're going to have the risk of a very deep slowdown in the first half of next year, and that will cause the Federal Reserve to start cutting interest rates. In fairness, Anna Wong and the Bloomberg Economics team thinks that there's going to be 3 25 basis point interest rate cuts next year, like 1 a quarter. Our view is here at Bloomberg Intelligence Rates strategy is that the Fed usually isn't that cute, right? The Fed waits until it kind of has to cut, and then it cuts aggressively. So I think that that's much more likely. So the idea that we might be 75 basis points lower on the Fed funds rate by the end of next year is possible, but I think all of that will happen later in the year, in the fourth quarter, as opposed to a little bit each quarter. So I think that there is the possibility that the market's kind of getting that wrong. But then when you look at options on short-term interest rate futures, what you see is the market's really pricing for the Fed to do nothing or the Fed to cut 50 basis points, right? So it's kind of this continued bifurcation of views. and that's being expressed kind of with a 25 basis point cut being priced, but it's really not 25 basis points. It's 0 or 50, not just 25.
Hey, Ira, John here. Just a quick question: is the way up in price different significantly than the way down? Some of the nuances.
If you mean, when we had the significant bear flattening of the curve where 2-year yields went up much faster than 10-year yields, I do think that we won't just completely reverse that, because if the Federal Reserve is a bit slow to cut interest rates, it's possible that long-end yields wind up rallying first. So that's what we call a bull flattening of the yield curve. So one of the key tenets of our view this year is that, which is maybe a little bit different than consensus, is that we'll see duration outperform the short end. So basically, you see long end securities outperform the short end, even on a risk-adjusted basis. Now that will shift once the Fed starts to cut rates. But given our view that the Fed's not cutting rates until late next year and into early 2025, then 2-year yields are going to be slower to go down than long end yields. At least that's initially that's our view.
Hey, Ira, I'll tell you what I'm not going to be doing at 2 p.m. today, and that is reading the Fed meeting minutes. But I know rates geeks like yourself, you will be reading it. What will you be looking for?
Yeah, I'll be looking for confirmation of what Jay Powell said at the meeting a couple of weeks ago, and that's that, look, we intend on keeping rates steady for some time, right? And maybe there'll be some clues in there as to what some time means. And of course, the minutes tend always to be a little bit more nuanced and balanced. So are there phrases like, many members or most members believe that that the policy rate would have to remain at the peak for most of 2024, right? So little lines like that. It doesn't have to be explicit. It doesn't have to be everyone thinks that. But if it can give a clue as to how many people within the committee really want the base case scenario that Jay Powell laid out, which is for the Federal Reserve to be on hold for basically all of the next year. Of course, remember, we do get another dot plot in December. The September dot plot suggested that there was going to be another interest rate hike this year. I think that that's kind of off the table, and I wouldn't be shocked if there was some mention of that in the minutes of this meeting.
Ira, at what point can policymakers go back to kind of downplaying the threat of inflation, given the whole transitory issue and the fact that they underestimated inflation from the start?
Yeah, I think that whole kind of mistake, the whole transitory nature of inflation argument is going to wind up keeping them more hawkish and cautious about inflation going forward. So I do think that they are more concerned about inflation than they are about growth at the moment. And because of that, they're not going to get overly dovish. So we have a model called we call it our sentiment indicator. It's a natural language processing model that we use for both Jay Powell's speeches as well as the minutes, and we'll run that right after the minutes are out, and it'll be up on the terminal for people to look at. And what that's shown really is that we've gotten very, very neutral right now. And I think a big part of that is that they are still worried about inflation, will continue to be worried about inflation, so they still have a lot of hawkish sentences within the Fed speak. But at the same time, you have seen a slowing of the economy, and inflation is well off the high. So therefore, they have reason to think that they don't have to be as hawkish as they were, say, 6 months ago. So I do think that eventually they'll not worry about inflation, but it probably takes a deep recession and a much more pronounced economic slowdown than we've seen for them really just not worry about inflation.
Ira, I'm reading your note just from today, 3 keys for 2024, and one of them is the supply of treasuries to remain a counterbalancing factor. That is, the Fed deficits are likely to remain near $2 trillion over the next several years. So they're just going to keep issuing debt? Is that kind of the story?
Yeah, the federal government has to, and certainly that supply story is something that's going to, I think, keep cropping up over the next few years, where people are going to worry about who's going to buy all of this debt. So keep in mind is that we have about 55% of federal spending comes from Social Security, Medicare, and interest on the public debt, and that interest on the public debt is just going up a bit more over the next couple of years. So people are still going to worry about it. It's still going to probably put a little bit of a damper on rallies. So we'll still get rallies when you get bad economic data, people will, hop into treasuries as a flight to quality bid, but they might not be as pronounced as they would be if the debt levels were significantly lower. There's not much really Congress can do about it because of the nature of the debt dynamics. The thing that I think would work if Congress were to get together would be to do something like sequestration and just limit the growth in that debt.
Yep.
And then over time, taxes will wind up growing faster than spending growth, and that's really the only way to get those deficits under control.
All right, Ira, good stuff as always. Ira Jersey, he's the chief U.S. interest rate strategist for Bloomberg Intelligence, joining us from our Princeton office. So we appreciate getting some thoughts there. S&P 500 off 0.5%. And so we've got some marks, a little bit of red on the screen. Doesn't seem to be too crazy, but we'll keep an eye on it. Right now, let's head down to Washington, D.C. World and national news with Amy Morris.
All right, thank you, Paul. Prime Minister Benjamin Netanyahu will convene Israel's cabinet after signaling that a deal with Hamas to free hostages in Gaza in return for a temporary pause in fighting may be getting closer. We get more on this now. Bloomberg's Jody Schneider reports from Washington.
Details of it, but it does seem from the signs that we're getting that it's close. And President Biden said yesterday that they're closing in on a deal to free some of those 240 hostages.
Bloomberg's Jody Schneider in the nation's capital. President Biden leaning on lawmakers to change the nation's gun laws. Texas Congressman Craig Kazar says that something needs to be done to prevent another massacre like the one that happened next to his district in Uvalde, Texas.
We need to turn thoughts and prayers into real actions and solutions.
The Biden re-election campaign warns a second Trump presidency will, quote, cost more American lives after the former president told members of the NRA at their convention that if he is elected, he will support a tax credit to reimburse any teacher for the cost of a concealed carry firearm and training. Police in Ohio say a shooter opened fire at a Walmart, wounding 4 people before apparently killing himself. That attack took place last night at a Walmart in Beaver Creek in the Dayton metropolitan area. Beaver Creek Police Captain Scott Molnar says the 4 victims are currently being treated for their injuries.
Injured 4 victims. The conditions of the victims right now is unknown as they were all transported to area hospitals for treatment.
Now, police did not immediately release the name of the gunman, a possible motive for the attack, or any other details about that shooting. Meanwhile, in Colorado yesterday, another mass shooting. Police say 3 people were killed, a 4th in critical condition. Police say that gunman remains on the run. They believe he was in a civil dispute with one of the victims over property lines and easements. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News, and with this Bloomberg Business Flash, the November stock rally stalling out for now. This morning we have a mixed bag of retailer earnings. Also looking for results from AI chip maker NVIDIA. Of course, that comes after the close of regular trading. We'll be especially focused on the forecast. Another glimpse into the thinking of the Federal Reserve with the release of the minutes that comes at 2 p.m. Eastern. Meantime, Lori Heinel at State Street Global says the U.S. economy is not out of the woods just yet.
While we still think that a soft landing is achievable, certainly the risks to recession have increased pretty dramatically as tight monetary policy continues to weigh on economies.
And right now, Best Buy stock down 2%. The electronics retailer posting weaker than expected third quarter revenue. Also lowered their guidance. They're reflecting pretty choppy and uncertain environment. Lowe's shares, they're falling right now. Let's get you a quote. That's down just over 2% as well. The home improvement company trimming the full-year outlook and called out pressure on discretionary spending. S&P 500 overall 20 points lower. That's down about 0.5%. We're at 45.27 on the index. The Dow Jones Industrial Average is 100 points lower. The NASDAQ 100, 152 points lower. That is down a full 1% right now. 10-year yield, that's lower, down, let's see, 1 basis point. We're at 440. The 2-year is 3 basis points lower. That is at 488. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and
John,
Bailey.
Yeah, absolutely. John Tucker, thank you so much. We got Bailey Lipschultz sitting in for Matt Miller because he's on his 6-month maternity leaves, and he's going to take every day of it.
You say that with a tinge of bitterness.
Oh, yeah, more than a tinge. And he's going to milk that for the max, I am sure. Don't you think?
He's going to spend time bonding with the new one.
Very good. That's a much better way to... So Bailey Lipschultz is sitting in. We'll have some other folks kind of coming in to help out as well. So
I can see Bailey taking 6 months leave coming up soon, right?
Yep.
I am not expecting.
Are you betrothed yet?
No, I'm getting married in June, so I will be taking 2 weeks off in early July.
Okay, good for you.
Still planning that, though.
All right, good stuff. All right, we're streaming live here on at YouTube as well, so check us out there. So, Bailey, it's a time of year where strategists and people in the money management business start thinking about next year, you know, and a lot of folks even think of being farther out over the next 3, 5, 10 years. One of those is Sinead Colton Grant. She is a global head of investor solutions at a little financial institution known by the name of BNY Mellon, and she joins us here. Sinead, thanks so much for joining us here. I know you guys, you've got what you guys call capital markets assumptions. Kind of, you guys look out across asset classes for a long period of time. What are you guys thinking about as you look out going forward? Because it's been 2022 was a tough year, and 2023 has been a little bit better. But as you guys think ahead, what are some of your key themes?
Well, delighted to be here. And yes, so we have just published our 2024 capital market assumptions. And these are really the risk and return assumptions that are intended to guide investors in how they develop long-term strategic asset allocations. So this is very different than something like a 2024 outlook. This is much more long-term in nature. Now, you referenced 2023, or rather the poor market returns in 2022. So last year, when we published these expectations, our expected returns for several asset classes had moved considerably higher following those poor returns for particularly equities and bonds in 2022. Our outlook for 2024, or rather our expectations over 10 years, continue that theme, albeit at a slightly slower pace. And so a couple of themes that I wanted to really highlight. First of all, slowing inflation. Central bank tightening around the globe has really had the desired impact of taming inflation from the high single digits we were seeing to low to mid single digits in most developed market economies. But the last mile in getting inflation down to central bank targets is probably going to be the most difficult. And so built into these forecasts, we expect that central banks will begin to loosen policy soon, but we still expect that over the next 10 years, interest rates will settle at higher levels than we've seen in the last decade or so since the financial crisis. And those higher rates are one of the factors that drive our moderately higher return and volatility forecasts in 2024.
And how do those higher rates impact the investment in terms of different asset classes and the interest in where people should be putting money to work?
And great point. So I would say when we look across the asset classes, first of all, U.S. equities. Our expected return for U.S. equities really stand out among equity markets as being revised higher, and that's across capitalizations. It's largely driven by our expectations that the U.S. economy will continue to outperform the rest of the developed world. The focus on innovation in the U.S. is a particular tailwind, specifically when we think about productivity gains related to AI. And of course, higher rates means higher yields in bonds, and we think bonds will benefit not only because of higher current yields, but they're also going to benefit as the economy slows, which is what we expect, a slowing, not an outright recession in the near term.
Sinead, in 2022 in particular, that 60-40 portfolio really took a beating. There's just nowhere to hide here. How do you guys think about allocation here? I mean, presumably, alternative assets is also someplace you might consider. How do you think about alternatives and as part of a portfolio?
Well, it's a great question. And 2 points here. One, we all think about 60-40, but the 60-40 20 years ago was actually quite different and is quite different than what a straightforward public market exposure to 60-40 is today. And so that means that private markets become a much more important part of your portfolio, and also alternatives to really help with diversification. The thing that we often don't talk about when we use the shorthand of 60-40 is, even look at the number of public companies in the US at the end of the 90s. It was close to 8,000. Today, it's less than 4,000. So companies are staying private for longer. And it means that if you don't have that private market exposure, you are losing out on the ultra high growth phase where companies are going public. A lot of the household names that we would think about in recent years that went public, they were already large cap stocks by the time they came to the market. So if you don't have that private market exposure in your portfolio, you miss out on that completely. So I think that's point number one in relation to 60-40. You need to think broader, probably somewhere in the region of a 20 to 25% allocation to private markets and alternatives, depending on your risk tolerance. But the second point is that actually, over the next 10 years, purely from an index-only perspective, we expect a 6.4% expected return over the next decade or so for that public market-only 60-40 portfolio. That's because we see a moderately higher return in a number of equity markets, and also those higher fixed income expected returns given the starting point of yields.
And looking at AI obviously being the theme of the year, does AI have to work to drive markets higher, especially equity markets, when you're looking at what we've seen from the likes of NVIDIA and Microsoft in terms of sheer market cap being added this year?
Well, look, clearly it is not the only driver, but there's been a huge amount of excitement about the technology this year. What we think is really interesting when we look ahead, and similar to if we think about the advent of the internet, and we go back and think about .com. Look, there's a lot we don't know about exactly how this will evolve, but what we can say is that AI has the potential to significantly impact global GDP and global inflation over the next decade. What we're looking at near term is an early promise to automate some tasks. But really the full extent of its impact on productivity, global growth, disinflation, we haven't seen it yet. But our sense is that over the next 10 years, we're going to see astounding progress. We'll see a lot of new jobs created, new products and services that really haven't been invented yet. Right. And in the context of a broadly declining population in an economy, increased productivity is critical to support ongoing economic growth.
Right. Sinead, thank you so much for joining us. Really appreciate getting your insights here. Sinead Colton-Grant, she's a global head of investor solutions at BNY Mellon. Again, they have a report out, capital markets assumptions. So they look really, kind of long-term, 10 years, over 19 asset classes across equities, fixed income, and alternatives. So fascinating report. Take a look at that if you can find that report out there from our good friends at BNY Mellon. S&P right now off 0.3%. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. OpenAI says it's in, quote, intense discussions to unify the company after hundreds of employees threatened to quit if former CEO Sam Altman didn't get his job back. Altman was named to head of Microsoft's new AI team. Bloomberg's Alex Webb talks about what would happen if those who threatened to leave to Microsoft did.
And Microsoft would then get something that it currently does not really have, which is a captive AI researcher arm. It has got a very close relationship with OpenAI. It's the biggest shareholder, 49%, but it doesn't control that company. It doesn't have a board seat, as he was just saying. Bringing those people in-house would put it in some ways on a more level playing field with what Google has, even if you make the case that perhaps OpenAI is more at the bleeding edge than Google has.
Meanwhile, Microsoft CEO Satya Nadella says he's committed to Altman, whether he returns to the company he founded or not. Microsoft shares are down about 1%. And while there's been much talk about what's going on with Sam Altman and OpenAI, NVIDIA earnings, they're going to give us the real story about the actual technology. Cameron Dawson, Chief Investment Officer at New Edge Wealth, gives her take.
Now, we would expect from NVIDIA still that very bullish outlook about the promise of AI, but how much are they able to continue to really be able to surprise to the upside on earnings, which I think will be really important as we go into 2024, because that's when we see their earnings growth decelerate a lot. They'll have 350% growth this year. That slows to 60% next year.
NVIDIA reports after the bell, shares right now are down nearly 1.5%. And shares of Zoom are lower. They're down more than 1.5% after the company reported third quarter earnings that beat expectations and raised its full year forecast. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
With 120 countries, the moment news breaks. 24 hours a day, Bloomberg. 24 hours a day. Bloomberg. Content. 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 24 hours a This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, just looking at these markets here. We've got the S&P 500 off about 0.3%. NASDAQ off 0.8%. Keep an eye on the Russell as well for the small cappers, off about 0.7%. Yields pulling in just slightly. 10-year Treasury about 4.4%, so a long way from that 5% we had back in late October for sure. Oil. WTI crude oil pretty steady here, about $77.65 a gallon. A barrel there. Looking at gold, $2,004 per ounce, up about 1.3% today for gold. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. We're standing by for official word of a truce agreement between Israel and Hamas. This following talks mediated through Qatar. The rare public comment suggests talks over freeing some hostages are progressing and could lead to a limited pause in fighting. We get more on this with Bloomberg Israel economy and government reporter Galit Altstein.
Possibly 50 hostages will be released from Hamas, with 50 more possibly being added in turn for a longer ceasefire. And these hostages that are going to be released will probably be women and children. Let's once again mention that Hamas is holding about 240 Israeli hostages.
Bloomberg Israel economy and government reporter Galit Altstein. If the deal materializes, it will be the biggest diplomatic breakthrough since the October 7th Hamas attack. Elon Musk's social media platform is taking a liberal media watchdog to court. Bloomberg's Steve Rappaport has that story.
X sued Media Matters on Monday over a report that showed advertisements on the platform next to pro-Nazi posts. The company in its lawsuit accused Media Matters of kickstarting a blatant smear campaign and illegally interfering with X's contracts by trying to drive advertisers away. Media Matters dismissed the lawsuit as a bully tactic meant to silence critics. Several companies paused advertising on X after Elon Musk endorsed an anti-Semitic post last week. Steve Rappaport, Bloomberg Radio.
Most Americans are hoping to avoid politics at the Thanksgiving dinner table. A Quinnipiac University national poll shows more than 60% of Americans would rather not talk about politics. On the other hand, just under 3 in every 10 say they look forward to discussing politics this holiday. A news release from the university's polling analyst says a healthy dose of Zip It will be on the menu this year. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg. Paul and Bailey.
All right, Amy Mars, thank you so much. We appreciate it. All right, here's a story from Matt Miller, who thinks he needs these weight loss drugs, which he does not. Novo Nordisk expects shortages of Ozempic and Victoza to continue next year in Europe as demand soars for diabetes drugs that can also help with weight loss. Novo has failed to keep up with demand for Ozempic and its sister drug, Wegovy, a weight loss medicine, as celebrity endorsements and social media fame have made them among the world's most sought-after drugs. In order to boost supply of Ozempic, Novo said in the letter, it has temporarily reduced the supply of Victoza. So the demand is out there in size. And wait till they come up with the pill format.
Exactly.
It's going to go nuts.
And you're seeing massive sales. And as you mentioned, they're basically trying to taper off the production in Europe. One thing that's interesting to me, Paul, not saying that this is the driver, Ozempic costs a lot more in the U.S. than it does in Europe.
Is that right?
So they could be maybe pushing the product to the U.S. where everyone who can try to get a subscription or a prescription is taking it. But yeah, once you get this weight loss drug in oral form, it does seem like that's going to open another tier of the potentially massive $100 billion market that this could have. And this is coming as everyone wants to lose weight. But JT, I don't know if you remember the keto days, the Atkins diet, a lot of
I was going to say, isn't it a lot cheaper just don't eat a lot?
Well, this does actually encourage you to eat less. So we were actually doing the math, trying to see if you spend, $1,000 a month on this, how much do you have to eat less? It doesn't actually break.
And I can't believe some food companies and packaged good companies were actually calling this out as a potential headwind. I mean, you got to be
You're
kidding
going to
me.
see that in earnings, like when they used to blame the weather or whatever.
They blame the weather. Yeah, people just aren't eating as much, and so we didn't make our numbers. I think that's going to be. I'd call that out if anybody did that. But anyway, increased demand for the drugs coupled with manufacturing constraints has fueled shortages, including out-of-stock situations. So we'll have to keep an eye on that as this drug becomes more and more widespread, more and more popular. Weight loss. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk about bonds and risk. Ed Harrison, senior editor of Bloomberg News and author of the Everything Risk column, is going to join Liz McCormick, chief correspondent of macro markets at Bloomberg News. We're going to come in here. We're going to get a little roundtable go talking about the risk assets in general, 20-year bond treasury auctions, and all that kind of good stuff. And then we're going to go tech here. We're going to do that with Angelo Zeno, senior industry analyst at CFRA Research. Going to join us to preview NVIDIA earnings, which are going to hit after the close today. Then a macro view. Brent Schutte, chief investment strategist at Northwestern Mutual, going to give us his call on this economy and on these markets. A lot coming up in this hour. But first, let's kick it all off with John Tucker with a Bloomberg Business Flash.
All right, thanks, Paul. We are lower as we wait. S&P 500 right now, 14 points lower, down 0.3% at 45.32. The Dow, 64 points lower. NASDAQ 100 right now, that is a lower 137 points down. That is down 0.9% right now. Waiting for the Fed minutes. We're going to get those at 2 Eastern. And, of course, the earnings results after the close from NVIDIA. Economist Lindsay Piazza at Stifel Nicholas cautions investors, you know what, the Fed may not be done raising rates.
We are making progress in terms of taming inflation, bringing inflation off of those peak levels, but I don't think the committee is ready to celebrate quite yet that they've reached a sufficiently restrictive level. We've seen a lot of head fakes in inflation. We've seen a lot of volatility in the long end.
Sales of previous loan U.S. homes falling, the most in nearly a year in the month of October. And then you had some of the earnings results this morning. I don't want to steal any Jess's thunder, but let's see, Lowe's. I was actually in Lowe's the other day. I bought
there you go.
2 2x4s. One of them was like bent, so that was the straightest one I could get. Well, I won't get into it, but I'm going to try to refurbish a bathroom off the master bedroom. Best Buy had a miss on sales and lowered their guidance. They say consumer demand is uneven ahead of Black Friday. Trying to do my part. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate it. Bailey Lipschultz, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can go check that out. And we're also in your dashboards. Apple CarPlay, Android is also a player there. So just go to the App Store, download it, and you can click on it, and everything you want there, all the radio, all the podcasts, all the clips of the news, Bloomberg News, all there for you. Interactive Brokers is our sponsor, so we appreciate them. So it's all there. Looking at these markets, just a little bit of red on the screen, nothing to write home about here. But let's check in with Jess Metten. She covers all the equity markets and see what she's got for us. Jess, what are you looking at?
You're not going to ask about how officiating went over the weekend for the wedding in Texas?
That's right. You officiated a wedding?
I did.
Based
on the sketchy website I did online, I was asked to do this. It's not necessarily a side hustle, but apparently there's another wedding.
Do you have a legal authority to unite people?
They sent me a certificate and a sticker in the mail, and I have a little card now that I can carry.
So it's got to be official.
Member of the clergy here.
Wow.
So wedding, Peter and Allison, congratulations. But pro tip, 3 key words that y'all need to say after the bride comes down the aisle. Make sure to say this. Please be seated. I forgot those. So at a certain point, a few minutes in, the older people's knees, I think, started giving way, and they started to sit down. At first, I was like, maybe they don't like my speech, but then I realized.
As long as there's an open bar.
Oh, there was. Oh, there definitely was. I think that's why my voice is still a little hoarse there, but went well. Congratulations.
So if anybody needs to get wed, we can take care of it.
Apparently I do this now. I'll do another in another 3 weeks, so I'll have more stories back in Texas. Good. Other than that, though, the S&P 500, we are seeing it lower. Though I know Bailey's keeping an eye on those technicals, looking at the S&P 500 trading around those September highs still. But a number of the stocks, of course, we have NVIDIA that we're all focused on after the closing bell today, the last of the Magnificent Seven stocks. If you look through this morning, actually, it's trading up around 240% year to date. So this is the fourth biggest weighting in both the S&P 500 as well as the NASDAQ 100. So it's a little more than 3% weighting in the S&P and actually just over 4.5% in the NASDAQ 100. So Bloomberg Intelligence, Paul and I were chatting about this earlier with Tom Keene, estimating that quarterly sales could exceed consensus forecasts with a 170% surge on sustained generative AI demand for its accelerators. Of course, some of those retail earnings that we got this morning, Best Buy, ticker symbol BBY, that stock down over 2%. So same-store sales did fall by more than expected in the third quarter after what the retailer did call uneven consumer demand. Though I want to point out Dick's Sporting Goods, DKS, ticker symbol on that, up actually 6%, on pace for its best day since March 7th earlier this year. It did say, when you are looking at that particular stock, that third quarter comparable sales actually came in unexpectedly higher, and so it did boost its annual forecast there. And then, of course, we did also hear from Lowe's. We did hear from Home Depot last week, but if you look at Lowe's stock, down about 2% this morning, and the retailer actually did cut its forecast for the second time this year. So it does show a lot of that shift away from some of those big home renovation projects that we know so many Americans were doing during the pandemic, Paul.
Yeah, actually, really interesting there. So, I mean, the consumer, I'm hearing kind of mixed reports when you take a look at the consumer, Jess. I mean, you kind of see some of their guidance out there. I mean, the numbers are what they are. They're handling the margins. Some of these companies are really got their handle on the inventory issue, but they're still cautious in their outlook.
Seems more, especially company specific too, but the National Retail Federation is expecting that holiday sales will be around 2 to 4% year over year.
Yep.
So even though that is far lower than the pandemic peak, it's actually in line where it was before the pandemic back in 2019. So that's something to keep an eye on once we get past those Black Friday sales and Cyber Monday sales to see things how are shaping up. So clearly come off of that peak in the pandemic, but it seems like maybe things are more in line with
we like talking to Dana Telsey Advisory Group. She's kind of like my go-to voice on retail and trends and what people are buying and stuff like that. So we spoke with her last week to get a little preview, and she's cautiously optimistic, as she typically is. So we'll check in with her afterwards to see how it all played out. She is our go-to voice. Jess Menton, thanks so much for Reverend Jess. Are we going? Reverend?
Minister Menton.
Minister Menton. Yes. Minister Jess Menton. So anybody needs to get hitched, Jess is your person. Get it done. All right, let's talk bonds. Let's talk risk. Ed Harrison joins us. He's a senior editor at Bloomberg News and author of Everything Risk, a column, so check that out. And Liz McCormick, chief correspondent of macro markets at Bloomberg News. Both of those folks join us. Ed here is in studio. Liz is joining us via Zoom. Ed, I want to start with you because I got a problem, my friend. You got your latest note out, your latest opinion piece. Evokes 1999. I was there, dude. And 2000 was there. It's just not good. That whole bursting of the bubble. Although I did top tick the market, signed my contract with Credit Suisse First Boston February of 2000. Ooh. Boom, top ticked it. 3 weeks later, the world came to an end. I didn't care. So, Ed, you talk about markets and bubbles bursting. How do you kind of feel like we are right now as we head into 2024?
Yeah, I think that it's a good question because I think we're at a point where if things get a little more exciting, they could be too exciting.
Okay.
And I think it's interesting that we're talking about this on the day that NVIDIA is reporting. Because, I mean, is that not the company that sort of tells you whether or not it's going to be exciting or not? Because if NVIDIA is able to continue to outperform and therefore the stock goes higher, that tells you what the sentiment is.
Yep.
Well, with that in mind, I guess, are you in the camp of this is a market driven by 7+3 stocks, and how does that impact kind of your view of risk more broadly speaking, given every time I pull up a GP on the S&P or NASDAQ 100, it seems everything's rosy, but not so much under the surface?
Yeah, well, you know, the interesting bit is how the Russell 2000 actually responded recently as we've gone up. I mean, all of this was driven by rates and from where I can sit, and that says that, you know, rates went down, everything went up because of the potential for a soft landing. It's interesting when you say 7+3 plus 3. Like, you know, I'm thinking about the Magnificent Seven. It used to have Netflix in there. Do you remember, like 2 years ago, Netflix was ejected, and yet they continue to go higher. So what it tells you is that as long as the economy holds, and these companies can keep their margins going, we still have the potential for the rally to continue higher. The hope, however, is that it doesn't go into 2000 mode, you know, so that we don't get that sort of negative reaction on the backside of that.
All right, Liz, you're coming to us from what I call the yellow room, so great paint job there. What's the bond market telling us here about where we are kind of in the cycle? It seems like we've seen maybe peak rates. What are you seeing in the bond market?
Yeah, so I'm going to get to that. Just kind of getting my head around. Jess Menton could marry one of the McCormick kids if I needed in a pinch. But yeah, the bond market. So it seems like I hate to go with consensus because, we know what happened with the consensus going into this year, but definitely most of Wall Street thinks, and I don't think that's a bad call, that, we've seen the peak in rates. Like someone was saying, getting the 10-year note, remember we had almost 5s all across the curve. That happening again is a very high bar, right? Because most likely the Fed is done. But I think the bond market is saying the worst is over. How fast rates go down is an open question, right? There's a lot of uncertainty, I think, into next year. Even people saying the Fed's going to cut. Rich Miller in Washington was saying some smart stuff earlier to me and some others that, the question is, if the Fed starts cutting, why? Are they cutting for these kind of, call it technical, so rates don't get too restrictive if inflation goes down, or if the economy is doing very poorly and they have to cut quickly then and a lot? That's the bigger juice for the bond market. So I think just how far yields can go, the shape of the yield curve, most people see steepening, that's going to be yet to be seen because, this, recession everyone thought was coming this year didn't pan out. So we'll see what happens next year.
Liz, I try to avoid, these treasury auctions because there are a lot of smart people like you and Ira Jersey that do focus on them. But what have you learned from some of the recent auctions out there? Is our treasury refunding working?
Well, yeah. So the 20-year, which to be honest has always been like the lame duck here, or the problem child that is for Treasury. That didn't go so bad yesterday, and people were worried about that. We did have a 30-year recently after the refunding, even though they cut, they didn't increase it as much, so the size wasn't as big, didn't go well. But somebody was saying, and I think they're right, like, we've seen so much volatility in rates. To see a poor auction, it was not surprising. It was terrible. It had a huge tail. But I think, Treasury's getting their paper done. We'll see. We've gotten through the new issues of the refunding stuff. So, now it's going to be just the kind of regular monthly and then the reopening. So I don't know. I think if volatility can calm down, then in general, the auctions can go a little better.
Ed, is the market right now built on those Fed cuts actually playing out? Because I remember 6 months ago we were talking about cuts in 23, and now we're lining up cuts starting in the second half.
It's hard to say what's going on, to be honest, because people talk about paying more for longer maturity bonds. Term premium not in there. We have 100 basis points of differential between the front of the curve and the 10-year. 50 between the 2-year and the 10-year. The cuts that are priced in are sort of a mix between those two scenarios. Scenario 1 might give you a cut or 2 at the end of the year. The other scenario could give you 6, 7 cuts. That's the sort of like the 2000 episode that we're talking about, where the Fed just has to go to town and cut more. And so we're sort of somewhere in the middle, and it's hard to say what the market is exactly telling us.
Ed, do you think the Fed risks kind of, going too far, staying high too longer, and pushing this economy into a recession? What are you hearing out there?
Well, I think that a softish landing is not terrible from everything that I've heard that Jerome Powell said. And if you think about the numbers that they've been putting out for the last 6 months, I think it's the summary of economic projections in September and then in June. Basically, the numbers that they put out if you back out where we are in the unemployment rate, it suggests a mild recession, even though, of course, he says, and the Fed economists say they don't expect a recession. But if you had a mild recession, I think that no one would be, they'd be nonplussed. I mean, because that takes the risk off the table of, just hyperextending into a bubble and then crashing down.
Liz, looking at FOMC minutes later today, somewhat dated at this point just based on more recent data, what do you have your eye on from these minutes and what could be driving the market in the days and weeks to come?
Yeah, so it's definitely dated, especially as long rates, which, were one of the reasons why financial conditions had tightened, have come down a lot. So they've eased. But I'd like to see in the minutes, like, how confident policymakers were that, or not, that policy was sufficiently restrictive, right? Which Powell had said in the presser, he thought we were. But, that might kind of give an inkling of, if that was kind of just a squishy consensus or not. Again, the bar seems high for them to hike again, but given the backdrop of easing financial conditions since the meeting happened, I'm just really looking to see how much they thought conditions were tightened, and was it all about long rates, because a lot of that is reversed, and what that might mean for the future policy.
Ed, you've got your everything risk column out there. What's your biggest risk that you think the market needs to really be cognizant of going forward?
I think the risk is the risk of credit adding to some downside risk in 2024, because we've done a really good job in 2023 of keeping those credit spreads tight. But we have all the commercial property. We've got some bankruptcies bubbling up. And we have a decent number of bonds coming to market for refinancing in 2024. That sets up the potential that credit is front and center in 2024 in a way that it hasn't been in this entire cycle.
Right, because we really haven't seen. I mean, I guess it's from all that stimulus money we had at the beginning of the pandemic, but that's going to play out.
If you think about the pandemic, was there any credit stress except for March 2020? I mean, we really haven't seen it. We saw it with shale oil in 2015-16, but really, we've not had a bout of credit stress in a very long time.
Good stuff. All right, Ed, thanks so much for joining us. Ed Harrison, senior editor at Bloomberg News and author of the Everything Risk column, joining us live here in our Bloomberg Interactive Broker Studio. Joining us via Zoom, Liz McCormick, chief correspondent of Macro Advisors at Bloomberg News. A little round table of what's out there in terms of risk out there in those markets. S&P 500, we're down about 0.3% here. NASDAQ off about 0.8%, and the Russell off 0.8% as well. So a little bit of weakness out there in the marketplace. Yields pulling back a little bit. The 10 years off about 3 basis points. Let's call it 4.39%. This is Bloomberg. Let's get some company news now with Lisa Mateo.
Thanks, Paul. Best Buy cut its annual forecast just ahead of the holiday shopping season that kicks off on Friday. Bloomberg's Katie Greifeld explains why.
That's really being driven by what Best Buy says is uneven consumer demand. Big ticket items seen as especially weak. That is similar to Lowe's, and the chain also noticed softness when it comes to home theater and computing. You add it all together, and it's a pretty grim message going into Black Friday.
Best Buy right now down about 2%. Baidu top third quarter revenue estimates. Bloomberg's Ed Ludlow has more on its AI investment plan to help drive future growth.
Overall, this is a Chinese technology company that is seeing pretty sluggish growth, but is able to extract some upside on the bottom line. The AI story is that Ernie, its generative AI tool, chatbot, akin to OpenAI's ChatGPT, is giving some support to the top line.
Baidu's ADR right now is up about more than 1.5%. And turning to Meta Platforms, the president and vice president have joined its social media app called Threads. Now, this comes days after the administration blasted Elon Musk for promoting anti-Semitic content on his platform X, formerly known as Twitter. Meta right now down 1%. Meanwhile, Musk's X Corp is suing Media Matters for America, accusing it of trying to drive away advertisers by reporting that ads for Apple, IBM, and Oracle were running next to pro-Nazi content. And the company behind former President Donald Trump's Truth Social platform is suing about 20 media outlets. They want $1.5 billion in damages from news organizations, which reported that the platform had lost $73 million. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with his Bloomberg Business Flash. Right on the screen right now, S&P 500 halting its 5-day surge. You know, from a technical perspective, it's in an overbought level right now. Traders, they're awaiting the Federal Reserve minutes. We get those at 2 Eastern, and NVIDIA's results. Treasury seeing some small moves after the take-up yesterday of the 20-year paper. Lowe's cutting its forecast for the second time this year. And also on the earnings front, Best Buy same-store sales, they fell by more than expected in the third quarter. And then, again, Kohl's reporting a 7th straight drop in comparable sales. Kohl's shares, they're down 10.5%. Best Buy shares, they're 2% lower. Lowe's shares down 2.7%. Overall, the S&P 500 down 17 points. That's down 0.4%. We're at 45.29. The Dow Jones Industrial Average, 92 points lower. That is down 0.25% right now. And the Nasdaq 100, 142 points lower. That is down 0.9%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you so much. We appreciate it. Bailey Lipschultz, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. As John was just reporting, NVIDIA reporting results after the close tonight. The stock is up 240% this year. This is not a micro-cap stock, folks. This is a company with a $1.2 billion market cap. So monster creation. Trillion. Thank you. Trillion. Just a tremendous creation of incremental equity value just over this year. It's just amazing. You don't see that really that often. So the bar is set pretty high for these earnings, you would think. Let's check in with an analyst who kind of does this stuff for a living. Angelo Zeno, he's a senior industry analyst for CFRA Research. He's got a buy rating on the stock, and I see he's got a price target of $600. Stock's at 400, and let's call it $500 right here. So still some upside there. Angelo, I mean, again, stock up 240% year to date. That's a high bar for NVIDIA. What are you expecting after the close tonight?
Yeah, I mean, from a percentage perspective, this has had an absolutely incredible move, not only this year, but over the last 7-8 years, right? I mean, 7-8 years ago, you're talking about a company that was only a 20 billion market cap, and now we're talking, to your point, 1.2 trillion. Now, as far as kind of the quarter is concerned, I mean, we're looking for, again, another absolutely phenomenal quarter. looking for top line growth north of 170% year over year. That's really going to be driven by that data center business, which now is actually, north of 80% of their total revenue, whereas, 3 years ago, it was all about the gaming side of things, right? Yep. Gaming was about half of their revenue. Now it's all data centers. So we're looking for that business to nearly triple this year. And again, when you start looking at the CapEx spend environment for these large cloud providers going into calendar 24, and when you look at the pipeline that NVIDIA has going into calendar 2024, the visibility is phenomenal for this company, which is why we continue to have a buy recommendation.
Angelo, last quarter, company beat on revenue by 20%, earnings by 30%, and the stock did absolutely nothing. What does it have to do with this quarter, and what does the management have to kind of lay out for expectations rest of year and into 24 to drive the stock even higher?
Yeah, no, I think that's a great question. And I mean, especially kind of over the last couple of weeks, we've kind of seen a run into the numbers, right? I think it's up about 25% here over the last couple of weeks. So, I don't know if there's much that they can do to continue to drive upside here post the event. But that said, I mean, listen, as we kind of, what we're looking out for, I think, at least for this quarter, is really two things. One, on the China side of things, what do they have to say about that in terms of some of the restrictions that were placed? This is the first time they're really going to start to talk about that. Do they have some new chips that they can kind of circumvent? Again, the new kind of restrictions that had been put in place, the expectation is yes. So we'll see what they have to say about China. And then, clearly the competitive side of things is starting to change a little bit. You now do have AMD going into the market here. They are going to be available here in Q4, more entrenched as we go into 2024. So we do want to hear what they have to say about the competitive landscape, if anything has changed at all, what the pricing environment looks like, and what have you. So I think really that's going to be the key. And if they can kind of alleviate some of the concerns out there that might reside still, this might be a name that can continue to grind higher.
Angelo, I just want to go to that point you're just mentioning about the competitive environment. It seems like for a long time, NVIDIA kind of had this market to itself. Where were the competitors here? And how did NVIDIA get to this, just tremendous position of superiority in this, part of the business?
Yeah, I mean, listen, I think that the fact of the matter is when you kind of look at the GPU environment, you look at what NVIDIA has done on the software side of things, there really hasn't been kind of anyone out there that could really compete on that side of things with an NVIDIA. And even when you kind of look at AMD kind of entering the market here, they've kind of cited about $2 billion in revenue next year. I mean, we're talking about NVIDIA probably going to have north of $50 billion in GPU revenue in the data center space next year. So that's all peanuts. So NVIDIA will continue to command that premium because of the installed base that they have, the penetration that they have on the software side of things, and that is not going to change. Now, you are going to see more of these cloud players out there come out with their own kind of custom-based chips. You saw Microsoft announce it last week at Ignite. So that will stunt growth to an extent. But at the end of the day here, I mean, NVIDIA will continue to command north of an 85% share of the GPU landscape. And, Intel also is going to get into the market here in calendar 2025, but none are really going to be real threats. They're going to kind of get some of that low-hanging fruit out there.
Angelo, small pivot, just looking forward, Sam Altman getting hired by Microsoft. The expectation has been the divide at OpenAI had to do with him pushing for implementing AI faster than the board was comfortable with. If we do see Microsoft kind of unleash AI, how does that impact NVIDIA's business and expectations for their growth looking a couple years out?
Yeah, I mean, listen, I think it all depends on kind of what we're thinking about as far as Microsoft is concerned. But I mean, I think kind of if Sam, does kind of, if what we've heard is true, Sam actually kind of ends up in Microsoft, and that is, ultimately ends up being official. I think that potentially accelerates some of the AI initiatives out there in Microsoft. And at the end of the day, when you kind of think about how NVIDIA's growth trajectory looks like, it really is all pegged to how the success of the cloud providers are. And if we continue to see that healthy growth trajectory in terms of some of those AI initiatives, if we kind of see Copilot and what have you continue to kind of penetrate very well into the market, that bodes extremely well for more demand for NVIDIA's GPUs. Now, as far as kind of Microsoft and Sam kind of on his end of things try to develop their own internal chips, again, that's going to be something I think that's going to be more centered around their internal needs, because the enterprise space overall will continue to demand the NVIDIA's GPUs in our view.
Hey, Andrew, I want to ask you about Jensen Huang, the president, CEO, and co-founder of NVIDIA. Because when I think about tech moguls, you think Elon Musk or Satya Nadella or the Google guys or the Zucker and all that kind of stuff. This guy has got a $1.2 trillion company that's up 240% year to date. He's made a ton of money for a lot of people. How come we don't know anything about this guy? Is he the visionary here?
I mean, listen, I think he's, when I think about kind of the biggest visionaries out there on the planet, I always kind of allude to two guys. And to me, it's Elon Musk and it's Jensen Huang. Those are the two guys to me. And it really is kind of Jensen Huang, which really is kind of the mastermind at the end of the day when it comes to really kind of bringing kind of us to that new kind of world in terms of AI. And I think you're going to hear a lot more out of Jensen Huang over the years. And I think NVIDIA will kind of be that poster boy child in terms of that, kind of AI and kind of the evolution of AI into all devices out there. Right now, we're just talking about the cloud, but as kind of AI moves into the edge, whether it be autonomous cars or other capabilities out there, it will be, we think, NVIDIA kind of largely leading the race on that side of things. And again, NVIDIA, Jensen Huang and company will continue to kind of, we think, gain power over the years.
And as you mentioned, kind of where are areas for NVIDIA to continue to expand given its current domination in the markets that you're mentioning?
Yeah, I mean, listen, I think Jensen Huang actually put it best last week at Ignite when he kind of, kind of laid out the landscape for AI into kind of these three waves, right? The first wave essentially is something we've kind of already seen, and that's kind of a lot of what we've seen from startups, right? It's that startup wave where you talk about the character AIs, the open AIs, the world kind of coming to fruition here. And the second wave is going to be more of the enterprise adoption in terms of AI. That right now is really just on the cusp of things. All the co-pilots or what have you, with kind of Microsoft launching them here this month. So kind of the cloud side of things, the adoption on that side from the enterprise is going to be a huge opportunity for NVIDIA, not only here in calendar 23, but over the next couple of years. And then that third wave is probably the most powerful and biggest wave, and that is kind of more AI devices across the spectrum, across PCs, autonomous cars, all robotics and what have you. And again, that is where kind of that next kind of massive growth opportunity for NVIDIA is going to be. And that's going to take 10 to 20 years to really play out. So we're in this for kind of the long run. We think investors should be in this for the long term, although there are going to be pockets and cyclicality associated with this name, given the nature of their business.
All right, Angelo, thanks so much for your time. Really appreciate it. Angelo Zeno, Senior Industry Analyst for CFRA Research, talking about NVIDIA, NVDA is your ticker. You put that into your Bloomberg terminal, you can see some huge price appreciation, up 240% year to date. Right now, let's head down to Washington, D.C. Amy Marsh has got world and national news for us.
All right, thank you, Paul. Moments ago from the Roosevelt Room, President Biden addressed a possible deal between Hamas and Israel to free hostages in Gaza in return for a temporary pause in fighting.
We're now very close. Very close.
Let's get more now. Bloomberg's Anne-Marie Horder.
It's really difficult to talk about hostages when you're close to a deal because you don't want to give their families false hope. So it's very challenging. But the fact that Ismail Haniyeh, the head of Hamas in Doha, came out today on Telegram and said we're very close to this, quote, truce, says to me that we are potentially at the end of this negotiation.
Bloomberg's Anne-Marie Horder. President Biden also leaning on lawmakers to change the nation's gun laws. Texas Congressman Greg Casar says that limits on guns need to be part of the presidential debate.
There have been 35,000 people killed by gun violence alone this year. It's something we need to be talking about.
He says something must be done to prevent another massacre like the one that happened next to his district in Uvalde, Texas. Congressional leaders continue to fight over aid to Israel and Ukraine with a goal to get something done before Christmas. Texas Republican Mike McCall praised House leaders for keeping the government open.
This will happen, and I applaud Speaker Johnson for getting this two-stage CR accomplished to then give him and us time to move this emergency supplemental bill forward.
Congressman McCall says border security is a must if there's going to be any deal on humanitarian aid. Around 30 million people are expected to pass through the nation's airports this week. Officials say TSA is better prepared this Thanksgiving than in years past because of recent contract agreements leading to a nearly 2% increase in staffing levels. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Bailey.
All right, Amy Morris, thank you so much. We appreciate that. As Amy was saying, there's looks like there may be a potential hostage deal in Israel, which will be good news for all involved here. Let's get some latest reporting on that. We welcome Jordan Fabian. He is White House reporter joining us from Washington, D.C. Jordan, what do we know so far?
We know that Israel cabinet is meeting today to discuss this deal, which would result in a portion of the hostages that were taken by Hamas being freed in exchange for a several-day pause in fighting, in part to provide for their release. So we're talking about a limited deal here, but it is a first step, really the first step toward maybe easing this this conflict since it started with that Hamas massacre on October 7th.
And how critical is this in the steps forward that you mentioned being a first step for kind of a path forward?
Well, I think any limited ceasefire would be a shift for Israel, which has really been committed to pushing forward with its assault on northern Gaza and is now looking to southern Gaza to continue pursuing Hamas leaders. You know, there's been a lot of international pushback against this campaign due to the number of civilian casualties in Gaza, and you know the U.S. and other countries have warned that the casualty rate has been too high. So it's not clear this would result in a longer ceasefire, but I think some officials hope that this could open the door to talks about the future of this conflict.
Jordan, do we know how many hostages are being discussed right here in terms of being freed and maybe what nationalities they are?
Not sure about the nationalities, but there have been reports, and we've heard around 50 of the hostages. And to put that in the context, Hamas took around 240 hostages during that attack on Israel. So we're talking under a quarter of those that were taken initially. So not a like majority of them, but also not in a significant number either. And I think the hope is this would maybe open the door to more talks on hostage releases.
And there have been talks in the past, right? Correct me if that's wrong. And kind of what does this mean in terms of potentially, as you mentioned, getting more towards the full number of hostages that were taken?
You know, it's hard to say. Israel and Hamas have been engaged in these talks indirectly. The Qatari government, which hosts Hamas political office, has been playing an intermediate role, as well as the U.S. So, and just to say the least, there's not a lot of trust there between Israel and Hamas. So any future steps are very fraught, but again, this would represent a step forward from what we've seen over the past month plus, which has been nonstop conflict here and really only limited pauses in fighting to allow for humanitarian movements.
And Jordan, what has Israel said as to perhaps, if they've said anything, as to how far are they along in terms of achieving their gains, which in their words is wiping out Hamas?
Well, they've really wrought a lot of destruction in northern Gaza. Yep. They've taken out a lot of Hamas targets, but now they're saying they're turning their attention to southern Gaza because they believe the Hamas leadership and military forces fled Gaza City and other places in the north ahead of the Israeli attack. So in a way, they've accomplished something in that they've uncovered evidence of Hamas operations and they've rooted them out of Gaza City. But if that's the case, that they feel like they haven't really touched the central leadership, then they have a long ways to go in their goal of eradicating Hamas from the Gaza Strip.
And how important, I guess, kind of, Jordan, what's the meeting among Israel's full cabinet and kind of the timing expectations for this?
Believe they're meeting starting now, and there's several stages of this. Netanyahu will be meeting with his war cabinet, and then a security cabinet, which is a larger group, and then the full cabinet. We're not hearing any indications that there's going to be a holdup here, but he does need to go through the process here of clearing this with all of his ministers before he can give sign-off.
All right, Jordan, thank you so much. We appreciate it. That's Jordan Fabian, a White House reporter reporting from Washington, D.C. on a potential hostage, partial release of the hostages held in Gaza. So, again, we'll keep on top of that developing story. Right now, let's get a little bit of a reset here on these markets. We'll check in with John Tucker in a Bloomberg Business Flash.
All right, guys, we're lower but off the worst levels of the session. The minutes of the November 1st Fed meeting, they're due at 2 Eastern this afternoon. Minutes could provide details on how much policymakers have considered further rate action. The big event, of course, takes place after the close of regular trading. NVIDIA reporting results. They are down 1.6% ahead of that. Several retailers reporting disappointing results today. Best Buy falling 1.1%. Slow consumer demand expected for the holidays. That's weighing on the full-year outlook. Meantime, Margie Patel at Allspring Global looking ahead to next year and sees limited gains for stocks.
Really, I think we're going to be looking at modest growth next year, and that says that only those companies that are in sectors that have above average growth are really going to continue to participate, just like this year was dominated by a handful of stocks. I think that trend is continuing.
Right now, the S&P 500, 16 points lower. That is down 0.4%. We're at 4530 on the index. The Dow Jones Industrial Average, 96 points lower at 35,054. And the NASDAQ 100 is 137 points lower. That is down 0.9%. In the yield space, the 2-year down 4 basis points. We're at 487. The 10-year was down 2 basis points. That is at 439. Let's check commodities for you real quick. NYMEX crude, 45 cents lower, 77.36 a barrel. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Bailey and Paul.
All right, John Tucker, thank you very much. It is Bailey Lipschultz. It is Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. So head over to youtube.com and search for Bloomberg Radio. Well, on the inflation front, I mean, we've gone from a peak of 9% down to that 3 to 4% range. Great movement there, orchestrated by the Federal Reserve and the U.S. economy. But they still want to get to 2% at the Fed. So it seems like that last bit is going to be a little bit sticky. And what does that mean for the market? What does that mean for the Fed? Let's check in with Brent Schutte, Chief Investment Strategist for Northwestern Mutual. So, Brent, I mean, you know, the inflation continues to be the name of the game for this Federal Reserve, but the markets are saying, hey, I think we've seen peak rates, and maybe rates are going to go down in 2024. How do you guys think about it as you think about next year?
Well, I think you mentioned inflation coming down, and that's largely because inflation was tied to COVID. And so we were optimistic last year that inflation had peaked and thought the markets would behave better as inflation came down, as the economy returned to equilibrium. That is what's happened. Unfortunately, now you're looking like you're at the end of an economic cycle where the unemployment rate is low, you can't find workers to hire, and that causes wages to rise, which causes inflation to be pulled back up. And that's what we're worried about. That's why we think kind of this last mile on the inflation front is the hard part to go. Unfortunately, we think the Fed is going to keep the liquidity tourniquet on until they see the labor market weaken. That's when they believe that inflation will be sustainably at 2%, which unfortunately we believe will be coincident with a recession, because as has been brought out lately, once the unemployment rate starts rising past a certain point, it tends to trend. And we're right on the precipice of that, where you're seeing labor market weakness, which we think will continue to unveil itself in the coming months.
And Brent, we've seen markets react differently to recessions, just all things considered. How do you see equities playing out in 24 if, in fact, we do have a recession? And is it a bigger recession or a smaller recession?
Yeah, I mean, I think so far, I would say it's going to be a milder recession, because overall, you've let some of the air out of the balloon already. We've had kind of rolling recessions for the past year. Where you've seen manufacturing slip in, the existing home sales have been down quite a bit. And so you've seen rolling recessions already, which is a fancy way of saying we don't have as much to let out. The other part is that the consumer, as has been made out, is in generally good shape, but that will continue to deteriorate I think the sooner it happens, the better, because you won't have rates continue to eat away at the consumer and putting them in a weaker spot. So I do think mild. I think the market is capped right now. I think you're looking at a market that has some troubles as you move into the beginning of next year. I think the recession is mild, and then I think on the opposite side of that, there are better days ahead, especially in names that are cheap or parts of the market that are cheap, like small and mid cap, like value stocks, which I would argue have already priced in some probability of a recession. They're at cheap levels relative to, say, the Magnificent Seven or just the S&P overall.
So we were talking a little bit about unemployment earlier, Brent, and right now it just kind of inched up with the most recent report to about 3.9%. Where do you think the Fed would be comfortable seeing that number go before they start turning on the spigots?
I think it's more on the wage side. And right now, wages, which are kind of the product of a tight labor market against demand, I think they pay more attention to that. If you remember, Greenspan kept letting the unemployment rate go lower than what people thought because wages weren't rising as much. I think they're more comfortable with wages around 3 to 3.5%. In fact, the president of the New York Fed actually made that commentary. And so right now we're in the mid fours, 4.4 to 4.6% depending upon your measure. And that's where I think they wanted to get back down in the 3.5 level. The only way historically this has happened is through a rise in the unemployment rate, which I think is still the most likely outcome. And I think the Fed, Chair Powell says at every meeting, he talks about not wanting to go too far, but the biggest mistake the Fed could make with an emphasis is not getting inflation sustainably back to 2%, which to me is a way of saying we need to make sure that we get back to there because we don't want to repeat 66 to 82, where we let wages continually pull inflation back higher.
Yeah, Brent, I was going to ask, with higher for longer, what does that mean to you? Right now I'm looking at options, and they're implying 3 rate cuts by November, with the first coming right around midsummer.
I think this is one of the most difficult questions because I do believe rates will be lower. The reason I believe they'll be lower, though, is because we're going to have a recession. I don't believe it's going to be because we land softly and the Fed says, you know what, we're at 3%, but growth is slowing, so therefore we're going to cut rates and kind of fine tune the economy. I think they leave rates higher for longer until they get what they want. Unfortunately, I don't think they get that without some sort of pain in the job market, which I would argue you're already starting to see. And so, yes, I know that non-farm payrolls still show gains, but continuing claims, which will be out tomorrow, are up 28% year over year. If I go back in history, there has never been a period of time in which we didn't have job losses in which claims were up 28% year over year. In the non-farm payrolls, 52% of industries were hiring. Again, a sign of a narrowing job market and weakness. And let's keep in mind, as you mentioned, the unemployment rate has risen by 0.5%, which means there are actually more unemployed people. This is a level at which you're kind of at the tipping point. If we tip past here, typically things start trending, and you do get the unemployment rate moving higher by about 2% or so. And so I do think you're starting to see those conditions unveil themselves. And I think we're going to know in the next few months if we're going to have a soft landing or not.
All right, Brent. So given that backdrop, perhaps a recession, a shallow recession, what are the sectors you're looking at near? What are the factors? What are the strategies you guys are employing now as you think about, kind of risk capital here?
First and foremost, we've moved more towards bonds over the past year. And so we were very much in the camp last October till about mid this year that the market had a better backdrop because of inflation pulling back. We've since moved more towards fixed income, which at these levels, even with all the government debt issues and whatever else, I think you're being compensated for interest rate risk plus risk of government debt and everything else. And so at 5.2% on the Bloomberg aggregate, that's an attractive level. And we've been pushing more of our capital towards that. And so we are underweight equities. At the same time, this is where my positioning is a bit probably odd for most people. I do think small and mid-cap stocks are cheap, and I don't think you can time it perfectly, especially if it's a mild recession. And so therefore, we have put more of our capital towards those areas, which we think have already priced in some sort of recession at 13 times earnings that are not expected to grow next year and that have already been marked down by 12%. That's an area that I think you'll be very happy as you kind of see the recession unfold. And then we think about the opposite side of it. And so we're kind of, I guess, barbelling a bit our approach here.
Well, Brent, I was going to ask, with small and mid caps, are there industries, sub-industries, sectors that are more attractive than others in terms of what you expect?
I mean, they are more away from the quality commentary that has driven the S&P 500. I guess that's a different way of saying you mentioned factors. Certainly, I think the value factor, I think small caps, the size factor, I think those are areas that are set up to perform well over the coming few quarters once we get past this period of uncertainty. I'm not suggesting it's coast all clear yet, but I don't think anyone can time that perfectly. And you saw in the past couple of weeks, when those sectors and parts of the market take off, they do so very fast, which I would, kind of use as a warning sign for anybody who thinks they're going to be able to time this. And again, I think they've already priced in some of that with how far they're off their all-time highs.
All right, Brent, I'm a big fan of the University of Chicago's business school. What do you rank it 1 to 10? How was your experience there?
Oh, it has to be number one, right? I mean, it was incredible. It was a great experience, and I'm glad I got to go there. And the alumni network is fantastic, and so great school, great city as well.
Yeah, awesome stuff. A lot of I got my business school degree at Duke, and pretty much all of our economics and finance department, they're all trained at Chicago. That's where they were crushed with all the numbers that the University of Chicago people do. I was told there wouldn't be math, but anyway, Brent Schutte, Chief Investment Strategist, Northwestern Mutual. Proud alumni of the Illini, University of Illinois undergrad, and then he gets the MBA from University of Chicago. These are some serious math people over there at Chicago. S&P 500 off 0.3%. The NASDAQ off 0.8%. Yields pulling back just a little bit. The 10-year Treasury off, it's about 4.39%, off a couple of basis points today. This is Bloomberg. Let's get some company news out now with Lisa Mateo.
Hey there, Paul. OpenAI said it's in, quote, intense discussions to unify the company after hundreds of employees threatened to quit if former CEO Sam Altman didn't get his job back. Altman was named to head up Microsoft's new AI team. Bloomberg's Alex Webb talks about what would happen if those who threatened to leave Microsoft did.
And Microsoft would then get something that it currently does not really have, which is a captive AI researcher arm. It has got a very close relationship with OpenAI. It's the biggest shareholder, 49%, but it doesn't control that company. It doesn't have a board seat, as he was just saying. Bringing those people in-house would put it in some ways on a more level playing field with what Google has, even if you make the case that perhaps OpenAI is more at the bleeding edge than Google has.
Meanwhile, Microsoft CEO Satya Nadella, he says he's committed to Altman, whether he returns to the company he founded or not. Microsoft shares, they're down about 1%. And while there's been so much talk about what's going on with Sam Altman and OpenAI, NVIDIA earnings, they're going to give us the real story about the actual technology. Cameron Dawson, Chief Investment Officer at New Edge Wealth, gives her take.
Now, we would expect from NVIDIA still that very bullish outlook about the promise of AI, but how much are they able to continue to really be able to surprise to the upside on earnings, which I think will be really important as we go into 2024, because that's when we see their earnings growth decelerate a lot. They'll have 350% growth this year. That slows to 60% next year.
NVIDIA reports after the bell. Shares right now are down 1.5%. And shares of Zoom, they're lower. They're down a fraction after the company reported third quarter earnings that beat expectations and raised its full year forecast. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, a little bit of a sell-off today. The S&P 500 off about 0.3%. NASDAQ off about 0.7%. 104 points, 14,149 on your NASDAQ. Yields pulling in just slightly here. The 10-year Treasury is off about 2.5 basis points, 4.39%. Remember, we were at 5% just several weeks ago. Big moves there in rates. Oil coming off a little bit, off about 0.75%, just above $77 a barrel for WTI crude oil. Bitcoin off just about 0.75%, 37,150 for Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. We are now very close, very close. Those words from President Biden when he's referring to a deal for Hamas to release some of its hostages. The president says he's discussed it with leaders of Israel and Qatar. Bloomberg's Jordan Fabian tells us the agreement could be announced as soon as today.
The Israeli cabinet is meeting today, and they're expected to discuss this deal that's been in the works for weeks, and these kind of negotiations are very fragile. They can always fall apart at the last minute, but all indications are it's moving forward and could be finalized as soon as today.
Bloomberg's Jordan Fabian in Washington. The union representing American Airlines flight attendants asked a federal oversight board to allow it to end contract talks with the carrier, paving the way for a possible strike. Bloomberg's Mary Schlangenstein says compensation is the biggest sticking point.
As I understand it, the two sides are really far apart in terms of compensation over the course of most likely would be a 4-year contract. The flight attendants want some retroactive pay for all the time they've been in negotiations and haven't seen an increase, which would be since 2019.
Bloomberg's Mary Schlangenstein reporting from Dallas. American Airlines says a strike will not occur over the Thanksgiving and December holidays. The weather is causing some issues for those traveling to their holiday destinations. Some severe storms already hammered parts of the Deep South. We get more on what to expect tomorrow from Bloomberg meteorologist Gary Best.
Right now, Wednesday looking pretty good as the front moves off the East Coast, taking any rain and showers with it. Maybe some showers in southern Texas and a few rain or snow showers for the northern Rockies. But aside from that, it's dry almost coast to coast on Wednesday.
Bloomberg meteorologist Gary Best. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Bailey.
All right, Amy Morris, thank you so much. We appreciate it. Interesting story here on the Bloomberg terminal. Byron Trott says the small Missouri town where he grew up wasn't the kind of place that got regular visits from admissions officers at Yale, MIT, or his own alma mater, the University of Chicago. Now the billionaire banker who rose to the top levels of Goldman Sachs before founding his own firm is backing an effort to change that. Trott and his wife Tina have funded a $20 million initiative for those schools and more than a dozen others to step up their recruiting in rural areas and underrepresented towns from East Tennessee to Pecos, New Mexico. Trott's push to open doors is finding a receptive audience at elite colleges, which have been forced to rethink recruitment after the U.S. Supreme Court decision in June that effectively ruled against using race in admission. So stepping up rural outreach won't necessarily help increase racial and ethnic diversity, which universities say they're still committed to. But many schools are also sharpening their focus on attracting top students from parts of the country that have been overlooked and left behind economically. So that seems like a pretty cool thing.
Yeah, Trott's saying in the story that they want to include broader support, including guidance through the admissions process and helping prepare younger generation for academically and socially for college life. Paul, if you think about it, if you don't have a parent or family or come from a family that has college graduates or a litany or a line of people who went to college, you're underprepared, and that's really an interesting, cool thing. And I'm automatically going to think about Malcolm Gladwell's book Outliers and just the fact that some people really just are lucky and that works out in their favor. And hopefully this addresses some of that.
Byron Trott, an accomplished banker, of course, with Goldman Sachs, and his number one client, his main client, was Warren Buffett. And Warren Buffett is, famously said there are very, very few bankers who I will pick up the phone for, but Byron Trott is one of them. So that's a nice client to have. So anyway, some good stuff there. Trying to diversify some of these elite colleges. S&P 500 off 0.3%, 4534 is your level on the S&P 500.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to stay on top of this open AI story. It's just continuing to evolve, very fluid situation. Satya Nadella, the CEO of Microsoft, last evening, he spoke with Bloomberg's Emily Chang. So we're going to play some of that discussion, really fascinating, and we're going to follow that up with a discussion with Mandeep Singh. He's the senior tech analyst of Bloomberg Intelligence, and kind of get his view on what this means for AI and what it means for Microsoft. Seems like a win-win there. Our C-suite conversation today, we're going to check in with Tim Oliver. He's the CEO of recently public retail banking company NCR Atleos. Talk about his company and the outlook for the business. So all that's coming up. And we're going to preview travel. Apparently it's going to be kind of tough out there. This is a tough week to travel, but, you know, the hotels are all fired up. The airports, hopefully they can handle it all. So we'll get a preview there. Let's kick this whole thing off with Charlie Pellet.
Thank you very much, Paul Sweeney. Lots of moving parts, lots going on, and we've got you covered. Traders are awaiting the Federal Reserve minutes coming up at 2 o'clock Wall Street time. And, of course, after the bell, NVIDIA's results. NVIDIA shares are lower now, down by 1.5%. S&P 500 index advanced lower by 12 points. A lot of red on the screen, down 0.3%. 45.34 right now on the S&P 500 index. We've got the Dow down 80 at 35,071, a drop right now of 0.2%. The Nasdaq Composite Index down 103, down 0.7%. And again, NVIDIA, worth repeating, lower now ahead of earnings, down by 1.5%. 10-year at 4.40% with a 2-year 4.87%. Spot gold rallying $22 the ounce at 2,001 now, higher by 1.2%. Bitcoin down 0.7%, 37,155 on Bitcoin. And West Texas Intermediate crude is trading lower now. We've got WTI down by just about right now down by about 0.7%. Well, this is the time of the year when investors start putting out their forecasts for the next year and beyond. Sinead Colton Grant is Global Head of Investor Solutions at BNY Mellon Wealth Management, which has released its Capital Market Assumptions Report, and she was interviewed this morning right here on Bloomberg Markets.
Our expected return for U.S. equities really stand out among equity markets as being revised higher, and that's across capitalizations. It's largely driven by our expectations that the U.S. economy will continue to outperform the rest of the developed world. The focus on innovation in the U.S. is a particular tailwind, specifically when we think about productivity gains related to AI.
And you can hear more of that conversation on the Tape podcast. And speaking of AI, again, after the bell, we hear from NVIDIA. Demand for NVIDIA's AI accelerators is showing no signs of easing as tech giants like Microsoft, Amazon, Alphabet, and Meta Platforms invest heavily to ramp up their generative AI capability. Of course, we'll break the numbers for you as we get them and complete analysis here on Bloomberg. Again, NVIDIA shares down 1.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you very much. We appreciate it. Bailey Lipschultz, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. And we continue to follow the saga at OpenAI. After the ouster of co-founder Sam Altman yesterday, Microsoft Chief Executive Officer Satya Nadella joined our Emily Chang to discuss Altman joining Microsoft, its partnership with OpenAI, and goals for artificial intelligence. Let's bring you part of that discussion right now.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are. And, you know, I think about Sam has chosen multiple times now to work with us, and that's fantastic to see. And I think the real thing is that the capability that Microsoft has across the tech stack is what attracts great people like Sam, and people like Sam and, innovators like Sam when it comes to AI to come to us, and we are thrilled about it.
You incredibly quickly hired Sam as well as Greg.
We are hearing that Sam wants to return. Investors want him to return to OpenAI. How would you feel about that?
Yeah, as I said, we really want to partner with OpenAI and we want to partner with Sam. And so irrespective of where Sam is, he's working with Microsoft. And that is the case on Friday, and that's the case today. And I absolutely believe that'll be the case tomorrow.
So what are the conversations you've had with OpenAI's current board? From their perspective, where do things stand? And have you talked with Emmett Shear, the new interim CEO?
Yeah, I've had conversations with Emmett. And again, it's the same thing. There's no real difference there from where we were when we were working with Mira and she was interim CEO, or when Sam was CEO, and Emmett. So my message to them, Emmett, is very clear, which is, hey, look, we remain very, very committed to OpenAI and its mission and its sort of roadmap, and they can count on us. And then, as I said, we are also very committed to Sam and Greg and team that want to join us. If they're not at OpenAI, or anyone else who is at OpenAI wants to go somewhere else, we want them to come to Microsoft and continue to work here and in partnership with OpenAI.
To your knowledge, why was Sam fired? And to your knowledge, was he involved in any wrongdoing? Has the board given you a reason?
As far as I'm concerned,